like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should.
GETCRACK. Wake up, motherfucker.
Joining us for that is Tom Tesouris, who is Strategas' Securities Head of Fixed Income and Research. Also, he's the lead fixed income portfolio manager there. And Tom, thanks for being with us this morning. What do you think about this conundrum we've seen in rates? How, the rates have had their own mind. The Fed hasn't really had control here.
Yeah, and this has been a very bad year for the bond market. And it's been a year, in fact, where both bears and bulls have looked like they've been wrong quite a few times along the way. But we would agree fundamentally with why yields are rising at this point in time. But we just think the bond market's getting a little bit ahead of itself. In particular, there's a few headwinds to further increases in yields that are likely to hit in early 2025. And so those headwinds have to be dealt with before yields can keep creeping higher. But fundamentally, it makes sense that yields have crept higher, even as the Fed has cut, because one, the market had priced in too many rate cuts for 2024 and 2025. And two, the market was looking past at that point in time when 10s were down to 360, the enormous supply that is going to have to come on board in the next few years as the Treasury, one, continues to finance large deficits, and two, begins to refinance the Treasury bills that the Yellen Treasury had pushed into the market over the last 2 years. So that has to be dealt with. And this is the big reason why yields are rising. But we got to get through this soft patch in the first quarter of 2025 that we think is going to hit. And we also have to get through the debt ceiling increase, which until that debt ceiling is increased, there's going to be a shortage of treasuries entering the market for at least a few months in 2025. We got to get through that too. So shorts are going to have to be very cautious about maintaining positions with yields at these levels, because there's a lot of chance, a lot of risk that yields reverse drastically lower in the next few months.
I mean, I guess the good news is you're not talking about an inverted yield curve, at least between the 2s and the 10s anymore.
That's correct, especially with the Fed still likely to cut at least 2 more times next year, likely in March and in June. And even if they only deliver 1 more cut, you're looking at the Fed funds rate down to 3.75 to 4, and 2s around 4%. So 2s 10 spread should still be positive in 2025.
You know, the point you made about Janet Yellen and the treasuries that had been issued to this point, you're saying that that's the biggest reason for the issues right now because of the length of duration?
Well, it is as of today, but if you assume that we're going to be running trillion-dollar plus deficits beyond 2025, then eventually, cumulatively, that will overwhelm the T-bill issuance. But we've estimated that between, we'll say, 2022 and end of 2024, the Treasury pumped about $2 trillion of excess T-bills into the market. Those are going to have to gradually be scooped and tossed out to the 5 to 10-year portion of the curve majority, and that is probably a bigger concern for the market right now than deficit next year. The deficit next year should actually come down materially versus 2024. So it's scooping and tossing those bills that's a bigger concern at this point in time.
Big question, though, is what happens with inflation? Is it stickier than had been anticipated? And what about the economy? How does it hang in there? What's your answer on those 2 fronts?
Well, I think they're going to be working against each other for much of next year. And what we mean by that is that inflation is probably going to be coming down for a little bit next year into, we'll say, end of first quarter. We think inflation is going to trickle a little bit lower, and then it's going to get sticky again around a 2.25 to 2.5. We're kind of there right now. And then during that period, you're also going to see, we believe, a soft patch in the U.S. economy, driven in large part, I think CNBC has written about this recently, credit card debt. It continues to be a drag on the consumer, and that drag hits hardest in the first quarter. So we think there's going to be a soft patch next year. But then if you assume the economy reaccelerates, inflation is probably going to be going with it higher. So you're probably going to see in the second half of the year, you're going to see inflation trickling back towards 3%. And by the end of next year, it might be above 3% again.
It's now Tom Closa, global head of energy analysis at Opus, the oil price information services. And it was the highest level we saw since sometime, I guess, last year, Tom. And you think near term, there are some bullish factors for both crude and natural gas. But then the Trump effect might kick in for the second half of next year.
Yeah, I think the first 100 days of 2025 are going to be a little bit of a head fake. We do have a cold winter in the northern hemisphere, probably for the first time in about 6 or 7 years. And actually, if you look at the cold weather and the dome of cold weather, it's going to grip the country, in the places where we use heating oil or natural gas from about January 6th to January 20th. When the president takes office. So that could provide a little bit of a boost, particularly if Europe and Asia are cold as well. And the problem with winter is, we've got plenty of natural gas in the ground, but we don't have a lot of it downstream. So you get these interruptions where casinos and utilities get cut off from natural gas and they have to use oil in the meantime. So that's one thing that's going to push prices up. I think the other thing is Trump 2.0. Tougher sanctions on Iran and Venezuela. And not to be lost in this, the biggest fundamental of all is money flow. And an awful lot of new money flows into oil futures and options in January. That's not necessarily what we're going to see for the rest of the year, but we're going to be off to a sort of rip-roaring start, I would say.
Even though you point out big money is more enamored of crypto, in big tech, but beginning of the year, you still expect the energy complex to attract some of that money. So you think 80 is not out of the question for crude? We were just talking about how it's been in such a trading range, but then some of the lowest prices we've seen since before the pandemic.
Yeah, I mean, there's normally a high tide that takes you from, let's say, middle of December into April or May, and pushes crude oil prices up by anywhere from 20 to 43%. So we may see some of that, maybe not as dramatic as in the past. And $80 plus is not a big deal. We always overreact to the upside and we'll overreact to the downside. I just think that there's a problem once you get into April, and maybe we'll only see some additional crude from the United Arab Emirates, but 6 million barrels a day of extra capacity in OPEC plus members' pockets. That's going to wear on the market, I think, in 2025.
And Trump's promise, President-elect's promise of adding 3 million barrels of oil equivalent per day in his term, you think he can do that with his eyes closed? You think that's like him shooting 120? And you point out with his scorekeeping prowess at golf. I think that's funny that you said that. All presidents are pretty good at. I knew Bill Clinton always shot 80 after only swinging the club 110 times. He was able to post an 80.
We all shoot 80 on the first 14 holes, maybe.
Yeah, exactly.
And that's the way it's going to happen. But it's not a reach. It's not a dramatic moonshot. 3 million barrels a day, because it's barrels of oil equivalent. Some of it's natural gas, some of it's crude oil, and then a lot of gas liquids. We're the propane supplier to the world these days.
Liz Ann Saunders, Charles Schwab, Chief Investment Strategist, joins us now. It's good to see you. Welcome back.
Thanks very much. Nice to see you too.
As Mr. Kaplan was just suggesting here, there is going to be some level of uncertainty at minimum related to the Fed in 25. What about the markets at large?
So, what's been happening since the election, in the early part of the post-election period, there was a lot of enthusiasm about how strong the market was. But of course, that represented a shift back up to the mega cap tech and tech related names, magnificent seven kind of names. And throughout that process, we've actually seen now correction level declines and bear market level declines. If you look at the average member maximum drawdown, whether it's for the S&P minus 11%, for the NASDAQ minus 21% since that election period of time. Now, at some point, that breeds opportunity, because that's similar to what happened in the first half of 2024, where you had all the performance up the cap spectrum. There was a lot more churn and weakness under the surface, but that represented the setup for some of the broadening out that we started to see in that mid-July to early August period of time. So I think it does represent a setup at some point. I'm not quite sure we're there yet, though.
I mean, the more there is this level of uncertainty, the more chance you have of the top cap stocks leading the show again, right? I mean, you need rates to come down, and you need some degree of certainty to underscore why the broadening of the market would be likely to happen.
Yeah, I think rates coming down is an essential ingredient for a continued broadening out. That was part of the trigger for that move starting in mid-July for equal weight outperforming cap weight, for Russell 2000 doing well, because there is more interest rate sensitivity as you go down the cap spectrum, a higher percentage of zombie companies, smaller companies that have more variable rate debt, and they are more at the mercy of what's going on in the interest rate backdrop, both on the short end and the long end. And given this move that we now think is cemented, at least in the near term, of the Fed having gone from easing policy to pause mode, I think that has been one of the contributing factors to this shift back up the cap spectrum to those stocks that don't, all else equal, get hurt by that stickier, higher interest rate backdrop. So yeah, I think lower rates is certainly an important support if you want to start to see that small cap grind higher again, like we saw earlier in the year.
So you would stay away, just to be clear, from small caps?
Well, small caps is a pretty wide universe. I think it's if you're talking about the Russell 2000, almost 2,000 names, viewing it through a monolithic lens doesn't make a lot of sense. I think you can separate profitability versus non-profitability, zombie versus non-zombie. So when moving down the cap spectrum, stay up in quality. And there was a portion there of the small cap rally where you did see that lower quality trade kick in. You saw it in the non-profitable, you saw it in the zombies. And we were saying through that process, that's what you want to fade within that small cap rally and lean into higher quality. So I still think there are opportunities. In fact, if you look at the top 10 best performers in the NASDAQ year to date, none of them are in the Magnificent Seven. None of them are large cap names. They're all small to mid cap names. So there are opportunities there, but you want to maintain that focus up the quality spectrum from a factor standpoint.
What do you make of this notion that was put forth earlier by David Zerbos of Jefferies, who began the 9 a.m. hour with us, who said there's just too much being made, too much emphasis being put on tariffs and immigration and all these other issues, that the policies that are going to be pro-growth, tax cuts, and everything else are going to just supersede all of that. We could get a 15 to 20% return out of the S&P in 2025, possibly even hotter than that, he said. What do you think?
Well, that's possible. We have to remember there's a timing mismatch because at least if we go by the word and not to mention executive order versus congressional approval, you're talking about tariff and immigration policy being front-end loaded at the beginning of the year, and assuming not much gets done on tax policy until you actually get to the point of expiration of the 2017 tax cuts. That is later in the year. Yes, you could bring that deregulation piece a little bit earlier in the year, but I think that's it's the timing mismatch that adds to the uncertainty associated with tariffs and immigration, because those can be done via executive associated with tariffs and immigration, because those can be done via executive order for the most part and don't need that congressional approval.
All right, what's up, guys? Yeah, I don't know if StreamYard sometimes does that still. Stops playing like just before the end of a video. Okay, it's New Year's Eve, right? Yeah, we're New Year's Eve here. So let's take that off here. Yeah, okay, got that. All right. December 31st, 2024. Interesting past 2 trading days. Friday and Monday. So I thought, I was expecting that to happen after the New Year's, like a big drop where people just start selling their profits off, but they didn't even wait. They did not even wait. I think some people just really had to dump some stock, and I think most of it has been in the weaker sectors. So you heard that in the last video talking about small caps, very sensitive to rates, and that's why the whole small cap, I think biotechs too. Yeah, biotechs, small caps and mid caps, and some of the growth stuff in Kathy Wood's ARK fund, ARKK. So all of them, IWM, you look at the IWM XBI, I told you guys, they've all been weak since probably Thanksgiving, right? Towards the end of Thanksgiving. And we keep continuing to see that. And it's just getting worse and worse right now because of what's happening here. Because people right now have been selling not only those small cap stuff towards the end of the year, but they've also been kind of unleashing some of that Mag 7 that they've been hiding out in. Mag 7 meaning those Tesla, right? Apple, Meta, Facebook, basically, at Nvidia, and what else? Google, Amazon. Yeah, I might have missed one, but yeah, I think that was it. So this is gonna be weird, very weird January, I think. And I should talk about something that's pretty well known, and they call it kind of like the January barometer. I don't know if you guys know that or not, but usually you can tell how a year is going to be based on how January is going to be. So if it acts a certain way, you can guess how the rest of the year should act. Okay. So I think the past 2 years we've had very good Januaries. I believe so. Let me check. And let me get the January barometer. Okay, let me get that article for you guys and I'll read it. Okay, January barometer. All right, here we are. Okay, I'll read this one. Yeah, so get ready for January. Watch how it goes. Oh, and by the way, January 9th, there will be no market, okay? The markets will be closed, except for crypto, I suppose. They're gonna try to pay respects to Jimmy Carter, so the market will be closed January 9th. Mark that on your calendar. No open market then. So, January barometer. Some traders believe... Oh, jeez, I can't believe this ad thing here. I can't get rid of... Oh, yeah, this is the archived version. That's why. Okay, I got... Man. Okay, some traders believe the S&P 500 indices, right? January performance can predict its performance for the rest of the year. For example, proponents of this January barometer believe that if the S&P 500 rises between January 1st and January 31st, this will foretell a positive result for the remainder of the year. Similarly, it holds that if the market fares poorly in January, it likely will perform poorly for the rest of the year. So this was popularized by the Stock Traders Almanac. It's run by Yale Hirsch back in the day. Now it's run by his son, Jeff or something Hirsch. All right. Okay, let's see what we got. Any proof of this? Well, proponents of this view cite data showing that the January barometer has registered only 11 errors between 1950 and 2021, giving the indicator an accuracy ratio of 84.5%. However, this phenomenon may be largely illusory, After all, from 1945 to 2021, U.S. equity markets generate a positive annual return roughly 70% of the time. Therefore, the January barometer could just be a secondary effect of the general tendency of U.S. equities to creep higher each year rather than a special phenomenon that can be used to improve one's market timing. All right, so that's a criticism, right? You got that? So what I found personally is that like January kind of set the resistance and support for the whole year. So if you set the opening of the January to the close of that January, it like gives you two prices on the S&P 500. Okay? And you can use that to set your goals. You could say like after that January, then you go into March, April, whatever. Go to the quarters once they have earnings releases and things like that, right down the line. And then you see if the market tends to stay below or above those levels and see what happens. Because I would say that probably the last 2 years, right after the big 2021 bear market, you'll see that once we got past April into May, you'll see the market tend towards like the upper part of the January range rather than the bottom. And then from that a point on, you move up. Okay, so that's usually one way you could use it. So I don't know if I would say like, oh, I believe that a good January means like a good rest of the year, because usually, yeah, I think December tends to be a good month, and January will tend to be also following would be a good month. That's how the tendency used to be in a bull market. Now this year, you'll see that December hasn't been typical. December this year has been sideways or down, depending on which index you look at. You can look at the Russell 2000, you can look at the S&P, you can look at the NASDAQ individually, and you can see like, man, this December has been terrible. Very unusual. Usually Decembers are very good months after they follow November. And that's why I said when we had the big pump in November, we were already 30%, right? 30% in the S&P 500 in gains for the whole year. If we ignored December and said like, if people sold right now, on average, I think most people's portfolios were between 20 and 30%, because most people just have 401ks that they barely look at. They're not going to be like traders or whatever. So I think on average, you would be between 20 and 30%. So it's very, very good year already. Expecting another 5% on top of that, and then going into January with another 5%, that is crazy. You cannot expect that. I think that could have happened if Jerome Powell said the right things, but he didn't say the right things. He opened his mouth, and we fell right back. And now the last few trading days of the year, we're right back to where we were when Jerome Powell like crushed the market 3-something%. So now I'm very curious how the first 2 days of January is going to end up behaving, because there's a lot of people that are waiting for the change of calendar year to sell their stocks, because they don't want that stuff affecting their tax for this fiscal year, right? 2024. So if the next day after New Year's we go blood red again, watch out. We are going to have a real weird January. Really weird. So yeah, expect some crazy stuff to happen. Don't expect the same. All right. Would you use the January barometer on indices? No, I only use on indices. I don't think they work for stocks, but you could try working for stocks. I don't know. I don't think it means anything for stocks, but for the indices, yeah. I think it's fair to use it that way. But I personally don't try to. I'll use it as a range for the indices. I'll use it as a gauge for the rest of the year. I'll say like, okay, January behaved like this, and depending on where the S&P 500 acts around the resistance, support, or whatever you want to say, the upper and lower bounds of that price, then I'll decide what I feel like, if I'm bullish or bearish for the whole market for the whole year, right? Because I think you can determine just by that. If you stay above January's prices very quickly in the first quarter, you'll know right away. You're like, oh, okay, we're probably going to have a good year. But if right off the bat you go, and 2021 is an easy example. 2021 had probably the worst January ever, right? So it had the barometer effect. You see, like, dang, this is the worst January in a long time. And then the next couple months after that, and this is just before Russia did the invasion with Ukraine, it was still going down, and it stayed below the lowest level of that January. You just, every time you tried to rally back up, you just rallied right back up to the lower levels of January. You never got past it. You just kept like fighting. So within that first quarter, so you go to February, you go to March, you just completely, I think March was the last time they had a big rally, and it got up right next to that January bottom. And then right after that, poof, flush. The toilet flush just went right straight back down. All right. So let me see. I'll just pull up a chart. And yeah, you guys should look at history, and look at how markets behave. And you can tell right away that there are patterns in that sense where you look at the calendar years. So like I told you, quarters, everything moves by quarters and everything sets the tone. And then also we have presidential elections, things like that, seasonality. And so you can tell right away how things are going to move just by a couple months, okay, at the beginning of the year. So you can look at how it behaves towards the end of the year, December, and then we look to how it behaves into the January, then you'll know. And for individual stocks, that's why I always look for like the losers and the big winners in December. I want to see, and then I want to see how they behave in January to decide like, okay, can this continue a trend or is the trend broken? That's usually when it's going to happen. So like Carvana is like my favorite example. Like the trend changed right in December into January. So I wouldn't say like, oh, I'll use the January barometer to decide like, oh, this stock will do this thing or that thing. No, not necessarily. I'll definitely pay more attention in December and January for individual stocks, just because like people will sell losers because they lost for a whole year or even more than that, and they'll sell at the bottom, and new buyers will come in. Or the other way, where like Sprouts Family Market. Sprouts Family Market had a worse December right now. It looks like, I think when we get to January, this stock that used to be good for several years is probably changing. I think we're done with that company. Maybe people are getting out and it's going to switch. And I'm not in Sprouts Family Market, but I like these type of stocks to look at because you want to see this kind of pattern continue. Because then you can notice right away, like, oh, yeah. You want to pay attention all the time between December and January to look for new stocks to buy if you do long-term investing. Anytime you want to do any kind of long-term investing, Palantir was something I bought right at the bottom, right? So you want to buy, when you're looking for new stocks you're potentially looking to buy, look at the December and January, and then see if it's like that. Or if you're looking at stocks you want to get out of because you've been in like Palantir right now, right? Who knows? By the time we get to January, maybe Palantir is going to shift and we're done, because now everyone's talking about Palantir. Nobody cared about Palantir like 4 years ago, right? It's a meme stock. Now everybody wants to get in Palantir. I think when so many people want to talk about Palantir on CNBC, I'm out. I'm done with that stock. I'm moving on. I'm going somewhere else. So this is also a good time. You look at your long-term portfolios. You make your decisions, okay? How you want to rotate around and say like, okay, it's time to go find a new guy to play for the next few years. And I think the new guys are going to be oil and natural gas, probably more natural gas. See, Tropes is like energy looking green today while most other sectors red. Yeah, that could be a sign, but I don't think it's ready yet. But I would say like, yeah, the tech stuff is going to be played out very quickly, maybe in a couple days even. It's not even going to last to January or even one quarter. We're done here with tech. And the better play now, because actually I believe XOP, the ETF for, let's see, yeah, XOP, let me see. XOP, the ETF for energy. So the last high was April 24th. Low was in September 2024. And then It rose on Trump up until Thanksgiving and then came right back down to that. Yeah. We're still at the bottom here of this range. Okay. So the whole of December, it was down at most like 16%. Yeah, it's up a bit. Since then. So it's only lost 11% this month. Could be a sign. Yeah, could be. It could be the bottom. So, yep. And also utilities. So yeah, I don't know. But don't be rushing into these things. All right. I'm just because big money takes a lot of time to change hands. It takes time to move money around. You as an individual investor, you could just buy and sell thousands of shares, no problem. You don't care. But when people are slowly trying to get out of Nvidia and Apple and Amazon, they're not going to do it right away. They don't just go in there and go market order and press a button and get out. They'll sell shares little bit by little bit each time. So every time it gets a high, it'll just do a little bit. So we could be going sideways in January. And then all of a sudden by March, right, near tax time to April, then you'll start seeing it fall apart, right? It takes time. So because if you're just a little trader, you don't care about this stuff. But when you're thinking about like how things change trend, they move slowly. So when there's a big trend change, it'll take time to happen. It'll take time. So this could be it. We could be at the moment where we're getting out of tech, big tech, and they're talking AI left and right. Maybe it'll go sideways until the summer. It might last that long. If there's so much money crowded in Google, Microsoft, and all that, it'll take a long time for it to rotate out. And then by, I think, June and July, you'll really start seeing natural gas move up, and then oil later in the year towards the fall. Yeah, I think that's what's going to happen. So that's why I played that other video, first 100 days or whatever he was talking about, like it's a head fake. And then the very first video, though, was talking about the bond market. That one, what's important there is we're going to get a new Treasury Secretary. Okay. So it's going to take a while for this to work out because Biden will be there for at least up until the 20th. And then, the Treasury Department, I think they won't change their auctions. So you got to set what kind of bonds get auctioned off. What happened with Yellen was she auctioned off a lot of T-bills. T-bills meaning bonds that last between 1 month into 1 year. Okay, yeah, 1 month, 3 month, 6 month, 17 week, and 6 month, and then 1 year. Those are the T-bills. And so these people now are not going to get as many T-bills as they once did. And they're going to be, that's what he was saying. It was going to migrate into 5-year, 7-year type bonds, probably. So that's going to play a big part in how the whole bond market is going to get reconfigured. So we'll have to see, especially with the tariff stuff. I don't know. That's going to really, really affect how the stock market is going to behave. So everything we see now is just an artifact of what the bond market's been trying to say for a while. It's like small caps got big problems. Okay, anyway, watch for that. So it's going to really depend on how clever the new Treasury Secretary is, and also how Powell reacts to that too. So this is like two independent machines going together, trying to work each other's ways out. It's not coordinated. Let's just put it that way. Okay, they're both independent agencies. They don't work together. All right, let's see. IWM. Okay, here's the monthly chart of this one. IWM. Yeah, I don't like this. I don't like this at all. No, I don't have a forecast. If you want the forecast, go to the previous video. You got Larry Williams. Larry Williams, big time trader. He's got all the forecasts for you over there. Go look at the previous video. towards the end there. Larry Williams, 2025 market outlook. Here, I'll just give you a link. I don't got no crystal ball, man. If I got a crystal ball, I'd be a billionaire instead of just a weak ass millionaire. Here, Larry Williams. This is Larry Williams 2025 forecast. I put the link. It's on the screen. Go there. Larry Williams, yeah, very famous. He won, like, he probably made 1,000% in a year with a trading contest. He's the father of an actress, I believe. She's an actress, and she also won the trading competition. She the year after he won the trading competition, she won the trading competition. Michelle Williams. All right, I think she was in some popular shows back in the 90s, right? Dawson's Creek. There we go. Yeah, that's right. That's how I remember her from Dawson's Creek. I didn't really watch that show though. Anyhow, yeah. So, yeah, Larry Williams, very famous. He's pretty old now, so I don't know how long he'll live. So take as many. Not saying to put money. No, I don't have a hot take. I think 2025 is going to be a trading year. Trading year means like you trade. If you're an investor, you're going to hate 2025. And if you want to invest, though, probably you're going to have to wait for second half of 2025. That's when natural gas will really explode higher. So what I would be trading the first half of 2025 would probably be Chinese stocks. Chinese stocks will go up and down every time Trump and Xi go back and forth. That's probably going to be a lot of money being made there. Just going shorting and longing those things. Everything else, I'd have no clue. It's not going to be an easy 2025. Because right now the small caps ain't doing what I wanted to do. If it was, then I would be like, keep doing what 2024 was doing. But if it's not, then you can't do the same thing and expect the same results. Sorry. We got to move on to other sectors, man. So the tech stuff, small cap stuff, Cathy Wood ARK stuff. So all those predictions I made last month where I said like, well, if Powell said the right things, he didn't. That means, sorry. Do I think Tesla is going to go up to 700? Maybe. But is it going to go up to 1,400? Probably not. That's about it. Yeah. And other things like that. But we'll see. We'll see. I got to see how January goes first. All right. So let me get back to the chart here. So I got to go back to that. Can't get distracted by the thing. Yeah. See, this is a problem. You see this? This bowl shape? It's a smile. Smile is bullish. You would think this is actually similar to how gold looked like before gold exploded up. But here's the problem. You see this month? Red candle. Dude, that's a big red candle. You got a green candle that went up 11% in November after Trump got elected. Then you get a red candle, and the month's not over yet. We got a few hours left in December, but I would say this pretty much erases all the move that November did. Right? And I would expect January to stay here, and then from then on, it will just go down, 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 back down. This is the worst case scenario. Because when you have a chart that says you should be going up, and then you do a false breakout like this is a false breakout, meaning like this thing says like, I'm ready to go up now, and then you cancel that right away. You know what that means? That means you're going down hard. Hard. That means this thing will just fly straight through like knife through butter right here. And when that happens, oh my God, you better run. I'm not saying it's going to happen, but that's what it's setting up to look like. You never want to have anything like this. And the opposite is always true. Most people try to short at the bottom and then they get burnt. You know, people look like, oh yeah, it's about to go down. It's about to go down. And then they maybe they'll get like a false move down. And then all of a sudden it reverses and go backs up. And then it shoots up all the way up like crazy. So that's the other way. That's why you never want to see something like this. Never. This is way worse than what happened in here, 2021. You see, in 2021, it tried to move up, but it went back down. And this was all in 1 month. And then from then on, that was like the bear market of 2022 right here. Now this thing, damn. This might even be worse than what was going to happen in 2021. But who knows? Maybe this is not true. Maybe in January, it will just recover and we'll be fine. But yeah, that's going to all depend on what Jerome Powell says in the next, I guess, 35 days. He got 35 days until he talks again, and then the Bank of Japan. Yeah. When do you feel tech is done? Do you sell all your tech shares or keep all? Yeah, I'm done. I'm pretty much done. Because, like, you should have been in tech since COVID. It's over now. We've had 4 years of tech. And the AI stuff has pretty much ballooned for the last of those 2 years, right? I mean, that's it. When the move is done, it's going to be done completely. And you don't want to be around when that move ends, because there's a lot of greedy idiots. And you could see how they are, how greedy they were, because I could not believe a December could be bad. Decembers are rarely this bad. Like, the only reason this happened is because there were a bunch of idiots that bought here. You see, and I put this dashed line here. This was the top. This was the last time they had really good news. This was unemployment data in Friday, December 6th. And then the second good news was CPI, PPI, which pushed it up even further. But this was the last solid news here. And then you could tell right away when we just went through it, like here, right, and then we had to go right back down to where we were, because the whole real move after Trump won was from here, Halloween, up to here. So this is the QQQ, okay? NASDAQ 100. This was actually the only move that resulted, right, from Trump getting elected. So from here to here. So this level is going to be important. So after that, people got out, right? They were done with the trade. And then once the market dropped mid-November, then some people just jumped in and decided, like, well, damn, I missed out on buying in, like, who knows? Maybe these guys probably missed out on buying in September, even in August right here. And they probably decided, like, oh, man, I missed out on everything. Well, shoot, I'll just jump in here. And then when this thing just rallied, people kept buying up and up and up, you know, because they probably missed out on the first move. Then what happened was, like, the rest of the people that bought down here probably were slowly, like me, probably slowly selling their shares up and up and up. Every time it made a new high. I was mostly done by the first week of December. Like I said, like, yeah, I'll sell most of my stuff here. I'll just sell what little bits I'll have into January left over. But this move, that was it. That was it. That was done. This is where all the greed comes in, right? Because all the greedy guys that got here got burnt. Like, I mean, this is not a huge move, honestly, because you're still up like 20 something % for the whole year. But there were a bunch of people that probably were so greedy they just couldn't help themselves but leverage up and buy more options on their own shares. Like, who knows? You know, these guys could have been people that just kept their shares and just leveraged up with more options. They could, like, buy more calls. Who cares? Or sell puts. And then this flush comes down. And it's just like, shoot. So now they were like, okay, we recovered some of what we lost that day. And then they got out, right? Just before, like, they went on vacation. And then the market now is so weak because there's no liquidity left. Everyone's on vacation now, right? So I can't tell if this is a real move, because, you know, this is vacation time. Like, you shouldn't be having these kinds of moves during vacation time. What happens is usually you just drift up slowly up until here and then come down. But all of a sudden, this right away just comes down. It's just like, okay, is this real? Is this not real? This shouldn't be happening on a New Year, like just before New Year's. So I didn't even plan on having a stream. I was expecting this thing to happen like after New Year's and then talking about it. But since like Friday and now, I'm just so confused. It's like, this was supposed to be January. This wasn't supposed to be happening now. So this thing makes me think, like, whoa, that means January is going to be even more interesting. Very interesting. And we haven't even talked about Bitcoin yet, right? Once we get into Bitcoin and seeing all that stuff, yeah. When you see all the cycles align like we are now, I would say like be prepared. Be prepared, man. I think after January, you're gonna see some crazy stuff, even crazier things happen February into March and April. I don't think you guys are gonna like it. You are not gonna like it. You are not gonna like it. So if you're an investor, so if you got your 401k, okay, my 401k, I was in cash, mostly cash by this point in my 401k. So my leftover 401k, IRA, whatever, I went back and bought this here, okay, and I'm still unclear as to if I should just run out and buy bonds or something, because bonds look really cheap right now. But uh, because yeah, I'm concentrated in large cap stuff, and so everyone's hiding out there, okay, and I'll show you the chart like here where everyone's hiding out. So this will be more clear to you, right? Okay, where's Magnificent Seven? Recession indicator? Nah, I don't need that. Yield curve, blah blah blah. Oh yeah, okay. Okay, you see, this is where they're hiding out. You see that? Yeah. So this is the Mag 7 here. So the red and green candles, that's Mag 7. The S&P 500 is just this thing here where I drew it in bars. Okay. So let's say you got in 2023, which is pretty much the bottom of this whole bull run. The 2 years with the AI and all that stuff where interest rates paused. So this thing, you're up like 122% as of this moment. If you just bought a lot of those 7 stocks, Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta. Yeah, that's it, right? Yeah, that's it. Okay. And then if you were just doing plain Jane S&P 500 buying VOO, the VOO or whatever, this is about what, 53% right now as of this moment. So nobody's really afraid, okay? So I stuffed all my 401ks in the large cap. So I'm hiding out here, mostly here, right? And this hasn't dropped too badly the past few days, but it can get worse, okay, in January. I'm not sure yet. But for now, I'll hide here. But as you can see, yeah, I think most of the market is about to be going bye-bye. And if you went back to 2020, let's say if you bought right at the bottom of COVID, you're up 200 something percent. Like you made quite a bit of money right here. And let's say you like I don't know. If you were dumb and I guess you just held 2022 and just held throughout, you're still okay. Yeah, you're fine. You're fine. You're still fine. But for these 4 years, this is the end of it. This is the end of the road, probably. We're close to the end of the road, I think. And we made a minor new high compared to July. And you can see, like in July, you see this huge move up here in the Magnificent Seven. This was like almost 6%. And this was before the big move back down when the Bank of Japan did its raised its interest rates. So this could be a big setup for the next move, because as you can see, this huge red candle, well, it's not a huge red candle, but this is kind of like a spinning top, if you know that all about like learning Japanese candlesticks charts, and they'll call this a spinning top. And this is kind of like an indecision time, right? Like it doesn't know where to go. And like right now, these 2 candles down here, this is a weekly chart, by the way. These are weeks. These are weeks. So the last 2 weeks of December have been down, okay, but we're still up. So I don't see a lot of pressure to sell until I see what happens in January. If I see people in January just like panicking and going flipping out and trying to get rid of this stuff, then I know it's over, because small caps are weak. And the only reason the S&P 500 is still staying strong is because if you know that S&P 500 is a market cap weighted stock index. And right now, the market cap of Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta is 33%. Okay, so 33% of the S&P 500, even though it says 500 stocks, right? They're not 500 stocks that are equal, meaning like the influence of a stock like Intel doesn't have that big of influence compared to like Apple plus Microsoft. Definitely not, right? Intel is probably very insignificant. If Apple and Microsoft goes down in a day, that's definitely going to push something down compared to like Intel going down. Nobody gives a shit about Intel now, right? All right. So watch these 7 stocks. This is what's holding up the market right now. It's not IWM, I mean. It's not these guys. This thing went down 8% in a month already. Lost all the gains. Pretty much all the gains it made in November after Trump got elected. Because Powell said we're not going to cut rates as much as, well, that wasn't really the big problem. The big problem was like he didn't know what was going to happen in 2025. But yeah, so that's not good. That's not good. And you can see it with the TLT here. Yeah, and we still haven't even talked about Bitcoin yet. So because I think that's going to be important. This is TLT. And I've been buying at this bottom here because I get a nice dividend. You TMF or TLT, you get a dividend. You would have got a dividend on so if you held it into Monday 2023, so you held it to close 2020 December 2022, I mean, and then you sold on 23rd of December. Yeah, you got your dividend already a couple days later, right? So people got their dividends here before the end of the year. Now, I'm definitely going to be curious to see how this moves here because we're at the bottom, man. So TMF is like the 2x, 3x leverage. Yeah, it's around $40. And the TLT, this tracks the TLT. So TMF is 3x TLT, all right? And TLT tracks the 20-year to 30-year bond market, and we're at the very bottom. I didn't really expect it to go this low. I was like, okay, it'll just hang out just below 89 probably. This is a very strong resistance support level. But damn, we're back here again. This is as bad as April. Yeah, this year. And the worst times, if this thing keeps going down, that means the yields are getting to 5%. Okay, 5% yields on a 30-year. Yeah. I'm gonna assume that we're at 6-something%, I think, on our mortgage rates. So if it goes, yeah, that means mortgages are going back up to 7-8%. Yeah, that's not gonna be good. Yeah, that's not gonna be good. It has to hold here. It has to. This is terrible. Yeah, and I remember that day too, up here when the bonds were doing well, December 6th. They were on CNBC telling like, oh, bonds look great to buy. Yeah, if you bought that time, this was like at the very top. so I'm just kind of waiting and see. Like I gotta see more people get more bearish on bonds. If they get more bearish in January, I'll buy them. Because once you see all the idiots get suckered into like getting rid of bonds, I'll be like, all right, I'll do it. I'll buy it. Yeah. Well, Samsung was never really a good. I mean, Samsung's never been a good fabless. Well, not fabless. What do you call that? Like general fab. It's kind of like Intel too. Intel's trying to do that thing where they just do it for all customers. Yeah, TSMC has always been more popular than Samsung. So I'm not sure. I'm not sure if like that means anything. Because that was probably their earnings report. That was way back when. That was like a month ago. Maybe over a month ago. Yeah, that because like there's not many people getting new orders in Samsung. Is that a good thing or not? I don't know. That could just be a Samsung specific thing. But you'll know what's really bad because TSMC will have earnings on Thursday, January 16th. Oh, January. So yeah, you'll find out right away. If TSMC says like they're not getting good orders for for 2025 and because people have been hyping up that whole AI stuff, and you see all those AI stocks start going back down, it's over. It's over. It's over. Yeah, it's done, man. So yeah, watch out. So what? Like you see Palantir right here, right? You see that? That might have been the top, man. We might be over. I mean, by January, this thing might just be going down, 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 down. Yeah. It's been a good time. We had good times, Palantir, but it might be time to say bye-bye for you. Because I've been here since what, $7, $6 here. Yeah. So I mean, how greedy can you get, honestly? I think the AI stuff, it's over. Yeah. Should be doing great. Are you sure? Are you sure? I need to see the projections. I need to see growth. If people don't have growth, they won't care. Stock market leads. You have to show growth. Everything is priced to perfection. If someone's buying like TSMC, it better show like another 20-30% growth, man. Like let's say you bought this here, right? Down here. $60, $200 now. Yeah. How much growth does it have left? This thing hasn't been moving anywhere since October. The whole semiconductor space has been going sideways. Like, I think, yeah, it's very weak right now. This thing. It's reached its high since July. So SOXX, the ETF that tracks the Philadelphia Semiconductor Index, that was the last high before the huge crash. And guess what? This huge crash caused by the Bank of Japan. And if Jerome Powell says something bad and the Bank of Japan says something bad together, they'll speak with next to each other last week of January. And you add on top of that TSMC earnings. And if all three of those things don't do well, like, bye-bye. This thing is a huge top. This thing is a huge topping structure right here. And it'll just flush down right back here. Right back here. Because we already broke the trend. The trend was here, right? October 2022. This thing's already getting out of that trend. That trend's over. So this whole thing here where I drew this parallel lines here, I'll clean it up for you guys. Here, let me give you a clean chart. So this is SOX. Okay? This is semiconductor index itself. It goes from 2,000 to 5,800 from October 2022 to July 2024, right? So I draw here some line. Very simple. So I have a parallel channel. See, I just need two lines. I mean, two points to draw my line, right? Okay, that's geometry, right? I got that. 1 point here, that bottom. I found my second bottom here, October 2023. That was the second chance you could have bought the low and got here. And this is the last 2 years, AI hype. The last pie we got was July, right? And we haven't gotten anywhere. No progress has been made. We haven't even gotten up to the upper half of this channel. And guess what? There's another ETF that looks like this. This is the housing market ETF, ITB. See that? You go back down, you go up. You can't even, like, at least this thing made up to the upper half, but it didn't even touch the top part. It just went right away back down. And then it tried one more time, and it couldn't even get to the midpoint. And then it just broke apart. Down, down, down it goes. It doesn't mean it's going to crash right through. I'm sure it's going to fight here from now on this year. It's just going to fight. But I think by 2026, it's just going to go down. That's it. Because then the economy will just be over and the housing prices will be over. So this is what I'm telling you guys. Like, you can look at this, look at charts long term. Just take your chart, put it in a week, put it in a month, put it in a quarter, right? We can go back to SOX. So, like, don't be greedy, all right? You've got your money. Don't think this trend has been going on since the great financial crisis. Okay, this thing's been moving quite well. Anybody here that's been here since like 2008, right? Their 401ks should be booming. Like you went from $100 something to 5,000. This is not crypto. This is just an index of semiconductor stocks. All right. It doesn't take much to have the narrative change, and people saw that in 2022. That was a big shift. Actually, you could tell right here. Look at this. Look at the way this thing moved. So in October, you had this big push up, and then you went sideways for a while. And then when January came around, went right back down. What happened here? Was this TSMC? It could have been earnings from TSMC. It probably was something else though. Yeah. So I'm watching that January. I'm watching this January, and now we're going like this. This looks a lot weaker than how it did here. At least we made a new high in December, right? Look at us. We're not even making new highs in December. We're just breaking down completely. And I bet you January isn't going to help. So watch out, guys. Pay attention. Yeah, pay attention. Yeah. Yeah, I know you're reluctant, man. I know. But we're in a new regime. The reason why I'm telling you guys people to trade and things like this, dude, it doesn't matter, Eric. It doesn't matter. It doesn't matter about it. If no customer has money to buy, it doesn't matter how good the technology is. The reason you have stock growth, okay, Eric, is because people have already anticipated it. Do not get suckered into the idea that stock prices have to reflect what's happening now or what might happen, okay? It's what is coming around the corner. And if the growth isn't there, people have already anticipated it by buying up. So like TSMC, like you can look at it. It's kind of like Nvidia too. Like this whole move from October 2023 from 87 to 200. This has already probably taken into account what you're saying right here. They already know 3 nanometer chips are coming out. They already know there's nobody competing with TSMC, right? They know that. That's the news is already out. So that's probably, so when you look at this move from $80 to $200, that might have, the people buying the shares for that news coming up ahead are probably already have gotten in. There's no new buyer up here. So whoever wants to buy $200 TSMC stocks need more convincing to buy. They gotta say like, oh, ChatGPT version 10 requires 1,000 times more computing power. Okay, if that news comes out next month, that will boost the stock up. But if they're just gonna say, oh yeah, we cornered the market on this, no, people probably already figured that out. You gotta, yeah, it's priced in. That's the problem. This is where the mental game comes in. It's like, what does the market expect? Did it expect that already? Is it priced in? If it's not priced in, I'm not playing. So this is the problem. When you look at a chart, maybe you could tell it's like, hey, look at October 14th. There was some movement here. Some huge volume came up here, but look at the result. The next weeks that came after this October 2024, like earnings. This was the last earnings, right? It went sideways. So it had good earnings, but it wasn't enough to get new buyers. Now that means the next earnings, we got to watch it. We got to watch the reaction. Okay. So we're going to see the earnings coming up January 16th on Thursday. So since it's Taiwanese time, it's going to be like probably 2 a.m. 2 a.m. my time. So probably like 5 a.m. Eastern. They'll have their earnings out. Or it could be earlier than that, actually. I don't know. Maybe I'm confusing my time zones a little bit here. But it's Taiwanese time. That's when they talk. So you'll find out very early in the morning with TSMC. So I'm going to be watching that. And then we'll be watching like the Jerome Powell, which is probably a week after that. Okay. Yeah, that's going to be important. So anyhow, yeah, so let's go back to January effect. Let's go look back at the January effect here. So this was the 2022 January. You see, that was a big red candle. And then every move after that, you see it tries to get halfway that candle? It can't, right? So it stays in the lower half of that whole January range and can't even stay like, and it stays really close to the bottom of the body of the candle. And then from that point on, February, March. So March was the last attempt. After it couldn't do that, down, 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 right? Till October. So you could say that's like the January barometer or whatever. Yeah, could be. So let's look at the COVID one. January, it was a small candle. It was red. I don't know if that predicted like COVID, but it definitely was a bad January. Very rare. January was down 3%. So that was before COVID, 2020. So is the January barometer, was that true then? It looks like it was true. How about here? 2021, January, good January, up 4.85%. And it stayed up quite a bit. And I'm just looking at the small caps now. I'm not looking at the big caps here. So I'm just telling you, like, yeah, if you look at the index and you use this, yeah, it's probably a good way to tell if the month is going to be good. This one didn't work. Look at this one. 2016, January. Red, down 8.58%. Terrible January. What happened after? Bull market. Okay. So I think the 2015 and 2016, it was a currency crisis in Asia, or maybe it was the Eurozone crisis. I forget. I always forget this time. There was always a lot of crises happening around the world with the currencies. Yeah, I don't remember if this was Asia or Europe. Could have been. Yeah, maybe this was the Eurozone with the Greek debt. So it could have been a weird one-off year, but this didn't work, right? You had a bad January, but the rest of the time you were fine. Yeah, the rest of the year you were fine. So that didn't work. But I would say, like, yeah, pay attention to January's anyway, because as you can see, like, by the time you hit March, it recovered the loss of that January, and then from then on it stayed above it, and we're clear. So even though I would say I don't believe in the January barometer. I don't say like, oh, you have a bad January, you're going to have bad rest of the year. What I would say is, like, if you have a January, look at the bottom and top of the candle of that January, look at the range of that January candle, and then look at what happens in February and March, right? Right away, you can tell if something bad is going to happen, because I think by February, you'll know. You'll know. See, it doesn't take long. Because if you stay below that area that you had in January, you're probably going to have a bad year, right? But if you try to recover, because if you look at the 2016 one, you see the February, even though it went lower, it fought hard, came back, and then right away in March, it just pushed up. Okay, so I think if you take January plus February and March together as a whole, you can determine how things will go. All right, overall in the market. And I think COVID is definitely a weird exception where it's just like complete collapse, right? But I think the whole thing we've had since 2008 has been weird. This is what I'm telling you. The reason, okay, going back to your question, yeah, all-seeing guy, you're telling me, I know, I rather do long-term investing. I get it. I get you. The problem now, what I have is that all the investing we've done since 2008 has been because the bond market, right? If we look at the bond market here, like, the bond market has been suppressed for so long. Okay, it's been suppressed. So the bond market has been rising, and since 2022, this is no longer the case. We are entering in a new time, and this is not a new time. I'm just saying it's new to most recent investors. Most people haven't invested before 2008. People don't remember the time when we had .com bubble, and then we had George Bush, two-term George Bush, where the market went nowhere. When you look at the stock market during George Bush's 2 terms, you had very low capital gains tax. It was reduced during that time, but the stock market went sideways. And what happened there was that gold went up. Gold was the better play. Yeah, gold and oil. was the better plays because, well, George Bush. Than the stock market. You could have just bought barrels of gold and oil and did a lot better during that time than putting it in the S&P 500 over those same years. So if I just bought and held in that time before the great financial crisis, I probably would have made some money, but not a lot. I should have just put it in gold and oil. And so what I'm telling you right now is that we are returning to an old time where you have to understand there's bonds, there's stocks, and there's commodities. Right now, we're in a weird time where it's all about tech. So it's not even about the stock market. It's just about tech stock market. It's just like Palantir, right? Software. Yeah, it's bizarre times. This is not how it usually went when I started doing stocks. This is just bizarre. If you tried that in the old times, you would have got burnt. You try to buy tech stocks, yeah, sometimes you would just got your ass handed to you. This is very rare where you can just buy any random stock ticker and it says AI on it, and then it'll just fly up. Okay, so yeah, see, you're too new. You don't know the old days. I think we're returning to the old days. So I would be very cautious right now with whatever you're holding because it's kind of like the dot-com bubble all over again. Okay, because everything was .com. We're not at that point. We are close to that point. That point could be, so we could fly up second half of 2025, like one big last push up into 2026 and then crash into like early 2026. I don't know. I'm just guessing. I'm just telling you to prepare for it. I'm just not telling you to be like getting worried about it, but don't be complacent. We have to in 2025, we have to watch very carefully the signs. There are going to be signs. They are not 100% there yet, but I'm starting to notice little hints. I think it's not going to be fun. Yeah. You can be bearish about AI, and I'll play a video towards the end of this stream. I'll show you where Martin Shkreli is now down 50% shorting quantum computing stocks. Right here, see quantum computing, $6 to $42 in how long? 2 months. So he's in pain right now trying to short this thing. This thing could go up to maybe $60 before it goes back down. Yeah, I don't know. I'm gonna watch these next year too. RGTI, which Tropes, he's shorting that one too. This is 0.8. Freaking 80 cents, yeah, to 15 into, yeah. If you think AI is a bubble, quantum computing is one hell of a bubble, and people are already trying to short it. So this is why shorting, if you don't know how to time the top, you are in complete agony. So this is why trading is trading. Yeah, so, and you got to know the time, and hopefully maybe if I figure out this whole DeMark shit, I can help out with the timing. Yeah, it would definitely have, the only problem is the valuation, right? This might be fine in 20 years. It might just not be fine in the next 2-3 years. So for anybody to buy now at $15 is probably not wise compared to anybody that bought at 40 cents. So yeah, this is kind of up to you, right? That's why the market has to decide what the pricing could be. But honestly, the reason is simple. This does not shares, and when you look at the volume here, like how much has this been trading? Like 100 million, 200 million, 60 million in a month, and then all of a sudden this last December 3.87 billion shares have traded. So people have been buying and selling the same shares over and over, back and forth with each other, and the price just goes up and up and up and up and up and up and up. So yeah, that's kind of what penny stocks can give you. You know, it's very easy to pump, Very easy to pump, just like this. No, yeah, I don't think that you should care about the theoreticals, man. Theoreticals are theoreticals. When you're talking about the stock market, you better give me something tangible. Because if it's something like 20, 30 years out and we're at the end of this is okay to buy when you're in a bear market. Like if we're in a bear market, like here, right? Look at 2022, bear market. It's perfect to buy down here. But if I'm going to buy up here before the whole market is looking like it's going to turn around and go backwards, I think you better think twice. So the next time we have a bear market, right, probably in 2026, sure, I would look for stocks like this to buy if you want to do long term, but I wouldn't be buying it now. I'll be trading it. That's okay. Trading it's okay. Yeah. So that's all I'm saying. I think this is where you see the inefficiency of the stock market, where you see people get overly bearish and then now they're overly optimistic, overly bullish. And the truth is somewhere here. It's probably this company is probably only worth $1 anyway, right? It's probably the mean. It's always going to revert to the mean. It's probably $1, right? But people are just going to speculate and go like, oh, it's 18 now. Then they crash it down to like 20 cents. And then next it will be like, dude, what? Come on, man. Okay, so that's all I'm saying. That's all I'm saying. Yeah, that's all I'm saying. Anyway, everything calls to yes, that's right. That's what we're doing. That's what we're doing, the tax loss harvesting. So that's why we don't know yet. We'll have to yes, Bandit, we have to see what January brings. Because January we'll have the people that are waiting to sell because they don't want those profits affecting their fiscal 2024 taxes, okay? Yeah. I only use logarithmic. I don't know. Yeah, I think maybe that's just preference, but honestly, I don't know. I don't think it should matter. Maybe it matters. I don't think so. Yeah, I don't think it should matter too much. I think it matter of preference. Yeah, I think it might also depend on other yeah, I don't know. I've seen it both ways. I can't really tell if it matters too much, but I do like using logarithmic because when you get too much of a growth and you do long term, I rather use logarithmic anyway. Okay, let me just go through the yeah, that's right. That's what I'm saying. Tropes, yeah, natural gas. And we can go over some of those tickers later in January. Yeah, so that's about it. Okay, guys. Okay, I'm done with that. That's right, because we have to do percentage ratios, and you know, let's see. Like Zim is probably one of the ones I use as an example. Like look at Zim, right? Like if I didn't use logarithmic, this is logarithmic right now. So I go here on Trading View. If I set this to regular, you see the difference? It looks really different, doesn't it? And this stock is like it jumped right away off the gate because it started trading in January 2021, which was a great time for shipping stocks. If you remember, people were still in lockdown. Shipping rates were very high. People were buying a lot of goods. They weren't doing a lot of services. They were staying at home, buying a lot of crap from China. This thing exploded right off the gate. And if you just use regular scaling, arithmetic scaling, that's what they call it, and you just base it on price, you look at these candles at the beginning. Yeah, they're big, but they don't look very significant, right? If you set it to logarithmic, then you understand that most of the gains was in these first 4 months of trading, 4 or 5 months of trading. The rest of the move here, yeah, of course, it went from $40 to $90. That's good. That's good gain. But like if you bought it from 12 to 40, that's an even bigger. That's why you see the percentage, because when when you get profit, you look at percentage, right? I'm not looking at dollars. Like it could be $100 stock, it goes up $1. I don't care. If it's like a $1 stock and goes up $1, hell yeah, I care. That's 100% gain. So that's why, yeah, I'd rather use logarithmic. I have no reason to use arithmetic. I especially in this age, maybe people back in the 1980s when stocks moved very very little in terms, because you have to remember back in the 1980s stocks actually were forced to move within pennies. Like, so you couldn't go plus or minus like fractions of a penny or something, 3/4 of a cent or something like that. I have no clue, something like that. Or and so and other restrictions, but these things are gone now. We are digital. Everything can go to 0.00000 whatever, and stocks move like crazy. There, yeah. Come on. We've gone past that. We've gone past that. That's kind of like a lot of boomers might still use arithmetic because this was the market that they grew up in. But I feel like now the way the market moves, it's very intense. A lot of stocks do not behave in any rational manner, as you could see with like the quantum computing stocks. It's like I see no reason to be like, oh, let's do regular. Like, yeah, let's do regular, right? Like, it's just like, oh yeah, okay, wow, this is amazing. Of course it looks so good, but if you go do logarithmic, yeah, it doesn't look that amazing because like you're bouncing between $3, $20, going back down to $6. This is terrible. This is actually a terrible looking chart because of it's just highly volatile. Nobody should be touching this thing, but you shouldn't be like like complacent and think like, oh man, this is a great move because like the stock hasn't done anything since 2022. But if you look at logarithmically, trading up and down in 2022 to 2023 was huge. This was a huge gain. Going back down is huge loss down here, and then you got another huge gain. Yeah, so this distorts the view. I think this is a preference type of thing, but yeah, I use logarithmic. Okay, all right. Anyhow, okay, we covered that. And the tickers at the bottom, yeah, was from last week, so I didn't change any of them. I guess once the new year goes around, I'll look at them again. So it's like I guess we got an hour till before market closes. Let me check if anything's interesting that happened. Anything? Okay, let's see. Bitcoin. Let me look at Bitcoin. I haven't even looked at that this whole day. All right. We're still up here. Okay. Yeah. We're still doing this shit. All right. I see. So we're still fighting that whole 95. Now, to me, if I was looking at this thing, like look at the daily right here. Okay. Now this is kind of a messy chart. Let me a cleaner looking one. So here, I cleaned it up for you here. Okay. Like you see this? So the last move in Christmas, this was not good doing this. Right. So after Christmas, it just had a huge red candle. And you see the 18-day average going down, starting to go down. And now you're starting to see the 40-day starting to roll over. Now, I would suspect that, let's say January is good. Let's say people are just tax loss selling because they bought this top right here. And they're done. They'll be done tax loss harvesting, right? Pretty soon. Let's say it goes back up. Probably, I would say it can't go further than 98. 98 is a good stopping point, actually, because 98 used to be the area of resistance in November, because that was the high from the major move between election to this point. So around 98, 99, right? So around here. And watch what it does here in Thursday, Friday. Okay. And it should, crypto will still trade tomorrow. So yeah, watch it for New Year's. Say New Year's hits. Yeah, right? Just watch it. You can watch it at least and then see how it behaves. If it tries to fight up here, because this is the last red candle here. Let's say it fights really hard into Friday. I might give it some room to try one more chance to get to 103. Maybe there. But after that, I would be getting ready to short it hard. Like I didn't expect it to just drop right through here. I don't expect it to, but it could do that. Like if the market is pretty bad, it could do that. But yeah, at least try to get to 103, which is probably like half of this last red candle on this side. So this major candle is the biggest one going to set the zone. And since then we haven't even tried to get to 100. So yeah, get up to 98 at least. See what happens. But yeah, I would be getting ready to short this thing really hard because this whole structure here from here up to here to here, this is probably going to be some kind of distribution, and this was the final drop, and we're going back to 80, maybe 75, yeah, 80 into March. Yeah, maybe March. That's what I'm thinking. So if you're interested in shorting something, yeah, that's one thing you should do. Yeah, because I've been trying to like me. For me, I've been waiting to short because yeah, this was the last time I was in MSTX. I was in the leverage one here. I was doing the leverage one here. This was the last time here. Which probably was like what, December 5th, and then I did one last trade into December 16th, and this was Monday. This was before Jerome Powell was talking. So if I knew Jerome Powell was going to be so damn negative, I would have shorted that Monday after I got out. I would have traded that Monday because it was so easy to see. Because if you look at the way Bitcoin moved, you see that this whole area up here. So from Sunday night to that Monday, from December 15th into December 16th, and then the last chance was like December 17th right here. That was it. That was the last thing. Because once you saw that, you could see like it was already down. And the thing is like you see it going down ahead of Powell. That's a bad thing already, omen already. Right? And I think at that point, let's see what the QQQs were doing. The QQQs were trying to make a new high on that Monday. Yeah. So yeah, there was enough signs to get out. There was enough signs. I mean, anybody was like who was like hoping Jerome Powell was going to be 100% on their side, either way, bear or bull, you would have been gambling at that point. I don't gamble. I'll just get whatever easy things because you get the resistance, you get the support, you get the resistance. Like you got close to this green line. That's when I got out because once you like within like several minutes, you could see like it's struggling and then it's just like starting to go back. You're like, oh shit. And then the rest of the day, it's like going down, see, towards here. That's already bad. And this red area rectangle is already a bad sign. And then the rest of the time, Tuesday, this is still before he talked. Jerome Powell only talked here. And you're already like below that red rectangle. We haven't even tried to get back to that red rectangle, right? So if you're looking here, I've been looking. Like yesterday, I was really tempted to be like, well, should I get back in? I don't know. Like maybe I'll take a bite before this stream wraps up. I might take a bite. I don't know. I'll take a gamble before New Year's because you never know. Maybe this is a tax loss selling, and this will reverse right away, right when we hit the January 2nd. Okay, so I don't know. I'm thinking about it because I have nothing to do right now in terms of any major positions, and MSTR is very very volatile compared to Bitcoin, so you can get a real good trade right away, very good, like 20%, 30% with just the MSTX ETF, which is what I use. So MSTX, and if you want to short it, use MSTZ. Okay, MSTZ, you can use it to short. All right. So you don't need to have a leverage account and short it, or you don't need to use options if you don't know how to do that. So you can just do it right away, right now, and be like, here, I'll short here. Oh, use MSTZ. Actually, and I was using MSTZ probably in this point. This point here, because if you looked at MSTR, it already had problems earlier on. You see this red candle? This was about almost, oh yeah, just before Thanksgiving. You see this red candle right here, and this is hourly chart here. So if we looked at the 13-minute that day, I used MSTZ, and I was using MSTZ for about a week at that time. Here, let me get back here. Like right here. See this? So this is the first 13 minutes, second 13 minutes, and then you start doing this. Because if you look at the 13-minute 18 moving average here, the purple, and the 40 moving average, you see that? When you make a very good new high like this, and you just right away just reverse and just fall right into there, and then you see this whole range before that, right? So November 20th, you know that 464 is an important number. So it tried hard to bounce off of there, but went right through. That's it. You're done. You should short. You short right here, and then I sold right there. Then when I went back up here, or covered, I guess that's the most appropriate term. And you went right back here. You see the 18 moving average going down now, and the 40 starting to go back here, starting to turn around, go flat and turn around, and then that I shorted again and got out here. And then when I went back up here, yeah, I shorted again. I was done after that. I was done. I'm not doing that no more. I mean, I personally don't like shorting and shit, but you know, the same ideas about going long, you just do short. Same thing. And tropes, you already have the Joe Rabel book, right? Go learn it. You learn it, and I'm just using the moving average. I'm not even talking about the MACD or any of that stuff that he talks about and the ADX stuff. But like if you looked at the MACD, you could tell right away. Like here, you see this one here? It's below 0 now. So let's say you missed this move here. Let's say you missed all of it because I got in early before I got a confirmation. What Joe would do is like he waits for the confirmation. He lets this thing play out, go back up. And then when you go back up and you have the moving averages going down and you see this where you're below 0 and then you can't even cross over anymore, it's like, yeah, you short here. And then you just keep holding because if this thing doesn't turn back up, you just keep holding. And then only then you decide like, okay, I'm going to stop because I'm going to hit resistance here, support here. I'm going to go to the lower time frame, like something like 3 minutes. I'm going to go down and see if like it starts turning around. If it starts turning around, I'm going to cover. That's it. That's how he would do it. Okay. Yeah. So that's how he would do it. I'm not going to give you guys all that stuff like on this thing because I feel like a lot of this stuff. Yeah. You really can just look at the candles right away, how it moves like this one, right? You have a pop up. You have a pop and drop right away. I didn't short this one. I was long from here. Okay, this was probably because when I covered my short here, like here, right, and I covered it again. I went long. I sold here. I went long again, like here. I think I went long here. I just held that through these many days, and I sold here because right away the 13-minute it just kept going down. It's like fuck. Get out, and then it slices right through that rectangle area. So for me, yeah, you just try to find the resistance, okay, and then you look at the 18 and 40 moving averages, and you look at different time frames. So here the 13, I'll look at the 1 hour, basically 65. All right, because you can tell right away with the 65 because you would sell here because you're still below this resistance, and this moving average is starting to go down on the hourly now. And then when you did this one, you're just jumping up. And if we went to the daily, you could see, I think you probably would see in the daily, like this whole thing is moving up here and it's just struggling just to hold any of the gains, right? So then you would know, you would start your bias is now changing. Because then you're feeling like, if this thing keeps failing like this, then the next time it's moving up, and it fails and goes right through here, just short, right? So that's probably what I would have done. I would have been like, okay, Jerome Powell is going to talk on Wednesday. I see Monday looks bad. I'll give it a shot. I'll start a short here. I see Tuesday do that. Then I'll probably add to my short. And then when Wednesday hit and it started flying down here, I would just be like, hell, hold. And then only until Thursday, probably because here, look, it went right to that blue line. That blue line was an important area because it was tested in November 12th, November 13th, November 14th, and this was before the last big move up. Okay, and again, on November 15th, it tested it again. So I could say like, okay, this is the best time to cover. Like, I'm not going to short anymore. I'm being greedy now. I mean, it could have collapsed right away, but like, what news is left? Jerome Powell already talked on Wednesday. Thursday is like this. I know that news is coming out on Friday with the PCE. I would have been way too greedy to hold through all that. But it's like, fine, I'm done, right? And then from then on, you could tell it's still weakened because this thing hasn't even gone above Wednesday's level. And MSTR looks a lot weaker than Bitcoin. So if you wanted to short Bitcoin, yeah, short MSTR. Because MSTR is way more overvalued compared to Bitcoin. I believe most people that expected it to go up to 100K per Bitcoin already bought in September. They're done. They've been done since November. So the next people that want this thing to go back up to 600 are the people that think Bitcoin is going up to 200 now. All right. So if you want MSTR to go up to 600, 700, 800, and 1,000, whatever it may be, this means that the new people buying here are really expecting it to go to 200 very soon. And I would tell you that, no, I don't expect Bitcoin to be going there within a month. I think it could try to recover and go back to 100K. It might fool some people. And at that point, I would be thinking like, yeah, okay, maybe I'll buy here as a long, see if it can get up to like 364 and then reshort for it to go back down. Maybe you'll get lucky and it could get up to like 380 or even 400 before shorting again. But would I short down here? I don't know. We got January, dude. I mean, I want to see what January does first. But if you want to look at from pure technical standpoint, you see this? The MACD is already down below 0. This is not a good sign to be. It could easily bounce after New Year's, and it could recover with 2 good days. 2 good days, and you'll get out of the danger zone. Okay? And then from there, we'll see what happens within the second week of January. Maybe that's what happens. But it could also be that January is so bad, people are really afraid to hold anything in January that they'll sell right away, and this thing will just completely collapse and go all the way back down to 170, 120, whatever, because there's not much to look at here. Let's see, maybe 196 will be where it might hold. I don't know. Yeah. So yeah, okay. Watch it. Could be a good trade. So maybe one good trade long and then another trade back down to 196. How about that? How about that for a plan, guys? Let's go long up here to 365, 380, maybe 400, and then short it again and go back down. Maybe we're lucky. I love it when it zigzags like that. Like, I mean, that gives me a lot more like time to make money rather than just be like, oh yeah, I'm expecting a huge crash or something. Because when you have those huge crashes, it's very rare. I mean, I don't like waiting for any of that to happen. Okay. Yeah. Oh, you're just combining everything with Linda Rashke? Okay. Yeah. That's pretty. You got to find your own way, man. Yeah. If that's what you're doing, yeah. Okay. Yep, that's the right way to do it. Yep. So Tropes is talking about he just bought Joe Rabel's book, and I mentioned him before. You can go to his YouTube channel. So he has one, and he also does videos on Stock Charts TV. you can look at his recent videos, but you can also look at his older videos, no problem. I mean, it's out of date, right? Because he's talking about stocks that already did stuff, but back in the day. But it's very good to watch them, because if you watch enough of them, the real good thing is when you watch someone else analyze charts over and over and over again, this saves you a lot of time, because he goes over the same like steps again and again. It's very repetitive. Maybe for some people that's just boring, but this is how you learn. Really, you have to get used to seeing a pattern. Once you see the patterns, it's very rare for you to have to look up any information anymore. Okay? Yeah. It'll be like second nature. It'll be so easy for you just to go like, oh, that's a short. Oh, that's a long. Oh, that's a short. Oh, that's a long. It'll be so quick. Because a lot of times you have no time to be thinking. You just gotta instinctually just press the button right away once you see a pattern. Okay. Okay. So this is his channel, Joe Rabel. Okay, this is his channel. Go here. All right. And then you can go to Stock Charts TV and look him up. So let me do that for you guys. So you can use this link here. I'll put it in the chat, and it will automatically search his name, and then you can see it. Yeah. There you go. So Stock Charts TV. So that's where most of his main videos are, and he does other presentations too. I remember he did one with the Wyckoff guys one time. I have it downloaded somewhere. I'll have to look for it. Yeah, I'll have to go look at. Yeah, it has a playlist. You can find it. You guys can find it. All of this. So, like he's probably a really good teacher when he does his little things. And so yeah, the Wyckoff guys and him, like these people present things in a very nice and clear way to cover things. Okay. And if you look at it enough, you'll understand. So yeah, or you can get the book too. Whatever. The book's on his website, like Invest Like a Pro or something like that. Invest Like a Pro if you really want. It's just like $5. Yeah, something like that. Yeah. I believe it's like Joe Rabel Research. Yeah, Joe Rabel Research. Yeah, Rabel Stock Research. My bad. Here you go. There you go. Yeah. Okay. So, anyhow, yes, MSTR I'm looking at. What was the other one? SMCI. This has been my baby. So, you can see here, right? 18, whatever. This is where we've been getting in, right? 20, 24, whatever, getting in, getting out. And then this was the last big one, last big move towards the 50, right? And now we're in this range. So this is kind of a range. However, you can see like the daily, you see it's going below zero. A lot of stocks are looking like this right now. People are not happy. Okay, holding this thing into New Year's. So I got to see what's going to happen New Year's before I say something. But, you know, I'm willing to give a chance and buy. Willing to give a chance. So like yesterday, once I saw these drops, I'm just like, ooh, I'm getting very tempted. Very tempted, because if you look at this green candle was the stopping action here. Just like this red candle began the down, and this red candle here set the range here. So you can look at this as like a distribution. So this last move up, you see this is the stopping action here. It changed it because now we were just like going sideways, and then once we broke out here, you can tell right away it just within that 1 hour it just failed, because everything after that it just went sideways, and then the last candle of that Monday went all the way down. Okay, and we were stuck here, dude. dude. If you do this, whenever you do make a big move up and then you erase everything for the whole day, don't expect it to go up the next day. Like, guess what happened on Tuesday? Down. Guess what happened on Wednesday? Down. So the only time you're going to stop this is like here. You have this huge green candle, and now you stopped it. So for the most part, we've been trying to go sideways, right? So I'm wondering, wow, okay, is this an accumulation? Is this something before we move back up to 40s, or what? Or is this just a preparation for us to go back down some more when the New Year's hit? So a lot of stocks we got to watch for New Year's. The stair steps is let me check. I believe this one is the 18-day. So if I'm looking at the hourly, right, and I want to have the 18-day with me, I just put it on with it. So in TradingView, you can do multiple time frame in there. So I could put like the monthly one in here. I could do the daily one. You get what I'm saying? Yeah, you get what I'm saying, Tropes? So here, like, you see this? So I have my SMAs, right? I have 80 and 40, but I can also do a daily one. And I could put 5 and 18. That's what I did here. So I have the 18-day, and I have the 5-day, 5 moving average, daily moving average. Get what I mean? So in TradingView, you can do multiple time frames within all the same chart if you want. So you could do like this hourly one, but then you can do 1 day up. You can do that. And I could also put the weekly. I mean, it's going to make your chart really messy because then you have all these things with the day, with the week, with the month. So usually what I do is I have one with the current time frame. This is like the hourly, right? And then I'll have one time frame up. I'll do the daily. Yeah, you see that? Yeah, you can do it like that too. So otherwise, you don't need to. So if you're just looking and staring at one chart, you don't need to have 2 charts in parallel or 4 of them all at once. You could just do it like this. So you could tell like right away. Like here, see, this is the 18 daily one. So you could tell the hourly was going right up to here, and then we hit resistance. Yeah, you're hitting the downward pushing 18 moving average, right? There you go. Oh, and by the way, guys, here, let me show you like, and you know, it shouldn't have been a surprise that this area here would have been hard because you're doing a downward weekly moving average here. So yeah, I mean, it could have just kept pushing into 60. That was my hope, but once you saw it was struggling in the 40s, which makes sense because this huge red candle here and this huge red candle here, this sets the boundary markers where you will have a hard time going between 45 and 50 and just go straight to 60 because a lot of people were selling in this area here, and so they'll anybody that was buying, they'll probably sell back there. Okay, so that makes a lot of sense, right? Anyhow, lots of stocks to look at in the new year. HIMS is another one. It has a range too. Okay, so now we're stuck in this range. We tried last week to get back to 30. We did for a little brief time, and now we're back at 24. We still have a weekly moving average that's moving up. This thing is still looking bullish, but as I say, we are entering the new year's. This daily chart doesn't look good anymore. As you can tell, the MACD is now moving below 0. So a lot of similarities to the other charts I've been showing you with Bitcoin and all the other stuff, right? And now I'll show you the S&P 500. Guess what that looks like? Below 100, 0 too, right? MACD. This is not a good sign. Yeah, not a good sign. So what do you expect here? So similar to Bitcoin, what would you think would happen? Maybe it'll try to get back up to 595. Maybe another test of 600. But you can tell 18 days moving down. 18 days already moving down. The 40-day isn't doing that yet, okay? But it will. It will. So if January is bad enough, yeah, it can have a problem. And this squiggly line right here, I think this is the 18 week. So it's retesting it again. If it goes back here too many times, no, you're not going up anymore. You're probably not going up. You're going sideways at least. You're going sideways for January maybe. So yeah, that's what I'm expecting. Okay, guys. All right. Now I have some other videos to play. There's tons of them, right? I got tons of them. I think. Treasury Department hacked by China. Isn't that fun? Yeah, fun times. We're already having trouble with China, man. Trump's not even in there yet. Okay, let me get it for you guys. All right.
Back, U.S. Treasury officials saying Chinese state-sponsored hackers broke into the department systems earlier this month in what they are describing as a major incident. Emily Wilkins joins us now with the latest. Emily.
Hey, Leslie. Well, yeah, the U.S. Treasury said that a state-sponsored Chinese hacking operation was able to access the desktop computers of Treasury employees through a third-party software, according to a letter seen by CNBC. That letter goes on to say that the hackers were able to access certain unclassified documents that were on those computers. Now, the software company Beyond Trust said in a statement that the case involved a remote support product and said no other products were impacted. In a statement, Beyond Trust said they notified the limited number of customers who were involved, and it has been working to support those customers since then. They also say in the statement that no other Beyond Trust products were involved. Law enforcement was notified, and Beyond Trust has been supporting the investigative efforts. Beyond Trust also said they disclosed the incident on their website when it happened in early December, and since then they have provided updates as they've looked into what happened. A Treasury spokesman said in a statement that Treasury takes very seriously all threats against our systems and the data it holds, and says over the last 4 years, the Treasury has significantly bolstered its cyber defense, and we will continue to work with both private and public sector partners to protect our financial systems from threat actors. Guys, of course, this is not the first time that we have seen state actors hack into U.S. systems or target government employees. And I think at this point, we're still waiting for additional information on what, if any, type of information or type of data they might have gotten from this potential hack. And of course,
As big tech is getting hammered in today's sell-off, CNBC's Magnificent 7 index dropping more than 1%. Well, there's a new emerging threat to megacap's massive spending and America's dominance in the AI race. Deirdre Bosa digs into that for today's Tech Check. Hey, Dee.
Hey, good morning, Leslie. So here's a name that our audience may want to write down: DeepSeek. This is a new, free, open source AI model that beats the latest OpenAI and Meta models on key benchmarks, and it was made for a fraction of the cost. Now, it was trained by a Chinese research lab that used NVIDIA H800s. That's a lower performance version of the H100 chips that are cheaper, more available, and tailored for restricted markets like China. Now, I've been testing it out this morning, and on the surface, it looks and acts just like OpenAI's ChatGPT. And in fact, it actually thinks it is ChatGPT. When I asked, what model are you? It answered, I'm an AI language model created by OpenAI, specifically based on the GPT-4 architecture, suggesting that it was trained on ChatGPT outputs, which, leaving aside terms of service violations, it means that entirely new state-of-the-art models can be built on what is already out there. In other words, OpenAI's moat may be shrinking. If a model like DeepSeek can emerge with competitive performance, minimal cost, and reliance on existing outputs, it signals a rapidly shrinking barrier to entry in AI development, challenging the current dominance of industry leaders like OpenAI. Based on technical tests designed to measure its coding performance, DeepSeek outperformed other models, including Meta's Llama 3.1 and OpenAI's GPT-4o. And by the way, those are the latest state-of-the-art models. And that led Andrej Karpathy, a founding team member at OpenAI, to post, DeepSeek making it look easy today with an open frontier grade LLM trained on a joke of a budget. Now, to put that budget in perspective, It's pretty mind-boggling. It costs just $5.5 million versus hundreds of millions of dollars for Meta's latest Llama model and billions of dollars for GPT and Gemini models. This all raises an important question for investors. As the AI trade evolves and technological progress stalls, is training frontier models even a good investment anymore? Microsoft, Google, Amazon, Meta, OpenAI, they have made that a core mission over the last few years as they continue to spend billions building out AI infrastructure to train ever bigger and better models. DeepSeek did something highly competitive in just 2 months with dumbed down GPUs for less than $6 million. And guys, let's not forget this fact. It comes from China, whom Sam Altman and others say poses the greatest competitive threat to the dominance of US-led AI. Now, this model is going to be tested in the weeks and months ahead, but the implication, guys, of this is just massive and will ripple through the AI community.
Wow, Deirdre. I mean, we've been talking this morning about, obviously, the CapEx that we're expecting to be spent in 2025 on exactly what you're talking about. What is the core competency then here of the Chinese? Obviously, they're not using the latest chips. They don't have the computing power. They're not even spending on that. So what are they doing well?
And yet, I know, right? And yet, you're right. They don't have all those things. They don't even have access to H100s. And yet, they have built a model that competes with the ones from OpenAI and Meta. I mean, they've done this out of necessity using H800s, which, like I said, is a dumbed down version of the H100s. They've been able to do this, which essentially just means that these models are becoming more commoditized than ever. As that progress, the technological progress stalls, it's all about what can you build with the existing frontier models. And this is a perfect example of what a company that doesn't have to have built all the architecture, doesn't need those high-end GPUs, is able to do simply by taking existing outputs. It also raises questions between open and closed source models, right? They were able to do so. This is an open source model. That was always the fear here with Meta's Llama, is that it gives the Chinese an advantage. It turns out the Chinese didn't even need Llama. They just needed stuff that was already put out there by ChatGPT and others.
Now, wow, Deirdre, I feel like this is going to be a huge story in 2025 and the geopolitical ramifications of all of this as well. Really appreciate it, Deirdre Bosa.
Well, that hurts the growth argument, right, with semiconductors. If the Chinese can do the same thing with cheaper hardware, with a generation old GPUs, and why do I need 2 nanometer 3? Oh shit. Yeah, that's the problem. This is kind of the problem. What's the growth? What's the growth story? If you can't get a growth story, there's none, right? We'll have to see. We'll have to see. And that's when the turn of the tide happens in the stock market. When people no longer have a narrative to push the price of a stock higher, once that narrative starts getting chipped at little by little, and there's less people willing to buy an overpriced stock, that's when the turn happens. That's the turn. So be aware. Be aware that any of these news outlets can push out any kind of article, anything, very quickly, and send a stock tumbling down once there's nobody left to buy. Yeah. So that's the game. That's the game to make. How bad is this spooking investors with the hack news? I have no idea. I have no idea. I don't know. I don't know if it has any effect at all. I mean, people should be on vacation right now. I have no clue why anybody should be caring about any news. And I'm assuming we will find out very shortly once we get into the January, well into January, probably second week of January. Okay. All right. Let's see. What's the next one? Oh, productivity, man. Funny. These are going to be funny videos with the productivity. Productivity is a problem now. Huh? Okay. Let's see.
Ahead for the Fed, let's bring in Claudia Sahm. She's the chief economist at New Century Advisors and a former economist at the Fed. Let's start there on productivity. Do you have any expectations for productivity and its impact on the economy right now?
Right. Well, I just want to underscore what Steve said. Having productivity boom that we've had recently, this is the best kind of problem the Fed could have to deal with. Right, because this is, very good for the economy, grows the pie faster. What the difficulty for the Fed is trying to figure out of the growth we've had, and we have been living through this. The past 2 years we have had well above trend growth, and the Fed has had to try to navigate how to get inflation down. At the same time, we've seen disinflation. So a lot of that above trend growth we've had, that was this supply, that was this productivity. We also have had more workers come online. So the Fed does not need to fight that kind of growth. The Fed fights when demand-driven growth gets out ahead of supply and they need to slow things down. But of course, you can't look at a GDP number and have it tell you this is a demand part, this is a supply part. And it's very important because monetary policy takes time to work its way through the system, is how persistent do we think things are? And frankly, at this point, and when you look at the Fed's projections, when you listen to them talk, most of them are taking a pretty cautious view of the productivity path going forward. And we really haven't seen a lot of officials taking on and saying, hey, it's here to stay, this productivity boom, we're going to build on it. So they don't have that optimism built in their forecast. But I think that's something they're going to obviously continue to watch.
Well, is part of it too just understanding exactly what's causing the productivity boom, to understand its resilience and the implications for monetary policy, really kind of getting to the root of what's driving these buoyant numbers that we've seen?
Right, absolutely. And really, this productivity boom, the seeds of it appear to have been planted soon after the pandemic. And in all of the disruptions that were happening, we saw a burst of business applications, and which has held up over time, which researchers have carefully traced through other databases to see it's not just the applications, it's businesses starting with employers. And we know that younger, more dynamic firms tend to get the productivity going. So that's been important. It took, years to play that out. And then the other thing the United States has really stood out in this cycle since the pandemic is we have had a really dynamic labor market in that we moved a lot of workers to better and different jobs than they were before the pandemic. That was very disruptive. We can remember the labor shortages and how that was tough on businesses and on some workers. But that really put people, matched workers up with jobs where they were more productive than before. And it gave businesses a big incentive to make some more capital investments to make the workers they had more productive. And so we're reaping the benefits of that now. But then the question is, can we hand the baton off to emergent technologies and further capital investments? And that's where there's a big question mark. And technically, history is on the side of the productivity growth returning back down at a more normal, lower pace.
So, hey, Claudia, I want to come full circle. What does this all mean for the Fed long term? I mean, coming up on January 10th, we get the jobs report. But before that, on the 8th, we get those Fed minutes. What are we expecting, or what are you expecting to hear from these Fed officials about productivity, about the incoming administration? I feel like Jay Powell said, Fed members at least acknowledge that some of these policies might take place and the impact that would have on the labor market, on inflation, and other parts of the economy.
I can see it showing up in some of the Fed discussions this year are around what the neutral rate of interest is. Right. And it's a structural parameter in the economy that gets saving and investment in alignment. Productivity, potential output growth, these are integral. These are considered to be things that would tie in. Like if the economy is just more productive, it's growing faster, but growing faster in a very sustainable way, well, interest rates should be higher. That's a sign of a healthier economy. The Fed funds rate should be higher. That's what that you're not fighting inflation. You've just got a healthy economy with higher rates. So, but the thing the Fed officials haven't done thus far is, though they have been nudging up their neutral rate of interest estimates, their R-star estimates, we haven't really gotten a lot of dialogue on why. And they haven't moved their potential output estimates, which would typically be, the median official hasn't moved them, which would typically be where that is. And Jay Powell has been pretty allergic to going through in careful detail, parsing out the neutral rate of interest. So I think they're going to have this conversation. And yes, I think the minutes are one place to be looking for this, and definitely listening anytime to get a Fed official like, hey, you raised your neutral rate. Why? What's going on? What changed? See if it's productivity.
Okay, if you don't know who she is, people commenting on the wig or whatever, I have no clue. But she is Claudia Sahm, famous or infamous, I don't know which, depending on which side of the camp you're in, of the Sahm rule. Sahm rule I've discussed on John Galt's channel on the mainstream a few times, and it is a recession indicator, okay? It is a recession indicator. I can pull up a chart. You can look up what it is by yourself. It's used before, and the funny thing is that if it's been saying there's going to be a recession a few times already, and So the creator of the rule that you just saw, Claudia Sahm, she was kind of saying like, no, don't believe my indicator now, or whatever. It's well, she made the indicator way back when she was still working for the Fed. This was like probably decades ago, right? And so, who knows? Who knows? Maybe she has an agenda or not. But yeah, she's been saying like, yeah, don't really listen to it. I do have, I believe, a chart of this. You can look up Claudia Sahm, the Sahm rule or whatever on TradingView. They programmed it into the thing. Let me see if it's even in here. No, this ain't it. This is a different recession indicator. All right, let me see if I can find it for you guys. La di da di da. Okay, here it is. Here it is. I do have another one that indicates recession too. We can go over that as well. Okay, here. Let me show you it. The recession indicator. All right. Okay, you see that? So this thing called the Sahm recession indicator, SAHM. SAHM. All right, you can look it up. So usually it gives you a little warning when it turns yellow, and then when it goes red, you're in a recession. All right. So it did a pretty good job in 2008. It didn't exactly call the exact top, but pretty close to the top, right, of that one. Did it work well for the .com bubble? No, it didn't. It was a bit too late. You probably would have lost quite a bit of money before you got out of the market relying on the Sahm rule. Okay. How about when we had the recession in the 90s during George Bush the first? No, the stock market was doing okay, even though we had a recession. So that didn't work very well either. So it's pretty good at calling recessions, but not really good at calling market tops and bottoms. All right. And this is why you're gonna have to find a lot more indicators than just. There's not one thing that'll tell you, oh, this is the top, this is the bottom. Okay, this is just one of them. All right, and we've been flashing yellow quite a while. June 2024, August 2024. Now we're back down. So what does this mean? Are we gonna have a recession or not? So keep your eyes open. So yes, you can have that yourself. Go look it up. SAHM. Sahm, the Sahm rule. Okay. Now here's another one which people like to do. It's like the yield curve. Everybody likes to do 10s, 2s. They'll do 10 year minus the second year yield. I'll use the second year minus 3 months. All right. I use this one and I'll take an average of it. Okay. So this is an average, 18-day average. So once this thing disinverts, meaning that when it goes below zero, it's an inverted yield curve. And then once it disinverts up here, it gets above there. I'll wait for about like 100, 200 days after that. And that's when the market will crash. Funny thing is this thing kind of predicted maybe the COVID a little bit, kind of, sort of weird, maybe. Yeah. So once it gets above here, I'll probably add 200 days. So I'll start here. Once it hits above zero, I'll start it when it last cross, and I'll be like, yeah, that's it. If I'm more conservative, I'll push it off to when it crossed zero, but that depends. That depends on how much it is. But right now we're safe. I'm assuming it'll start crossing maybe in August, depending on how the Treasury market goes. We got a new treasurer coming in. So this was the next time. This was around 2007, 2008 financial crisis. You could see like it did it right here. It crossed zero right here. And then if you take like 200 days from the time it did the cross of the moving averages, yeah, pretty good timing of the top of that market. Pretty good timing. Anyway, something to think about. Okay, that's just another indicator, but there's a lot more. Okay, that's not the only two. All right, there's many ways you can figure out when a top is coming. All right. The other one was the Hindenburg, right? Hindenburg omen. I showed that a few times before, so maybe I'll bring those up sometime along and remind you to pay attention. All right. Okay. So anyhow, yeah, that's done. What's the next video? We got productivity is the best kind of problem. We played that. Now productivity boom could be a problem. Let's do the bad side of it. How about that? Yeah, let's do the bad side of things.
Talk about one area of the market that has maybe not acted like many thought it would or should or could the last couple of months, and that is interest rates. Because normally, when the Federal Reserve embarks on a rate cutting cycle, like the one that began with that half-point cut in September, interest rates, the bond market, tend to go down with it, with the hope being that the extra money will then flow into the economy. But this time around, that did not happen. In fact, rates have really gone up. Look at the 10-year bond yield. It went from 3.64%. That was the week of the first rate cut back in September, to now about 4.58, almost 4.6%. The 2-year, 3.57 to 4.3. So why aren't yields moving lower? Well, one of the answers could lie in what they call the productivity numbers, some of that data that all kind of goes into the goulash that the Federal Reserve looks at. Let's try to make sense of all this and bring in CNBC's senior economics reporter. You did not have a goulash reference on your bingo card for today, Steve, but hopefully it made some sense.
No, goulash is an official economic term, as you know, Brian. So that works perfectly. Listen, here's the deal. The U.S. has experienced a productivity boom. That's a good thing, but it also presents Fed Chair Jay Powell and the Fed with one of its great challenges for 2025 and how to steer monetary policy through it. Productivity, it's averaged 2.6% over the past 6 quarters, a turnaround from negative numbers that came after the pandemic. It averaged 1.5% from the great financial crisis to the pandemic. And this effect, these high numbers you see, is likely before any impact from artificial intelligence. Even a full or a half a point extra productivity growth, that's a big deal. Raising how fast the economy can grow without creating inflation. Investors, well, you got to figure out how to invest in it. The Fed has to figure out if it's real. Now, Fed Chair Jay Powell in November was skeptical it would last, but hopeful because it has actually been around for a while.
The lure on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years.
Back in 1996, then Fed Chair Alan Greenspan famously saw productivity even when it wasn't in the data. With the economy running hot and threatening inflation, Greenspan held the line on interest rates even while colleagues urged a rate hike. He was right, though he did question the valuation that was placed on it by the stock market. So the question for the Fed right now is it a short-term or lasting episode? Will AI, Trump tax cuts, and deregulation perhaps push productivity up even further? Could tariffs and deportations help derail it? And of course, how does monetary policy react? Well, higher productivity means Powell can let the economy run somewhat hotter like Greenspan did in the 90s. But it could also mean a higher terminal funds rate, maybe reflected in some of the yields right now, because demand for capital is higher when investments have higher rates of return from productivity. Guys?
You mentioned it briefly, but I do wonder, Steve, how AI feeds into this equation and when.
Well, most of the people that are writing about what we're going through right now, Sarah, are not seeing it. It's a little bit early days. What they might be seeing, though, is the capital demand for AI. I don't know if you guys you follow these headlines. So-and-so is going to invest $1 billion here, $2 billion here. What was Brian talking about earlier, in the last hour, that you can't imagine the amount of capital? That's really part of what's driving rates right now. Plus, the government is borrowing a lot. So you've got this conflict here, both the government and the private sector borrowing a lot. I think AI could be still a few years off. What I think we're seeing right now, Sarah, are sort of post-pandemic effects where one of the things in the literature is people got into jobs that they were better suited for with all the changing that was going on out there. You had companies that had to do without workers, so they figured out new, efficient, more productive ways to get the job done when they had big deficits of labor.
Right. No, they're doing more. They did more with less.
Yeah.
They were definitely more efficient. Steve, thank you. It's a really interesting conversation,
Pleasure.
which we will continue.
Yeah, that's the problem, right? Too much of a good thing, it's a bad thing. If Powell cares about inflation, and this goes back to here. So, all seeing guy says, "What do you think about cybersecurity sector?" I was about to do a lot of new positions in software companies, including cybersecurity. But after what Powell did 2 weeks ago, I'm probably changing my mind. Yeah, so this is why Powell is a big deal, and why you have to listen to what he says and what the effects that happen with the bond and stock markets and currencies. Also, we have a strong dollar right now, not good for stock markets. You don't want a too strong dollar. That's also bad for gold and silver and platinum, which are things that I want to get back into, but right now they're still weak because of that same reason. So we have a lot of issues to work out. I can't say anything anymore right here. I've done what I've done. You got the money where you got the money. And that's it. I think anybody that wants to be greedy now, well, you take your chances. I've done pretty well already for the past couple years. So I'm not going to be telling people to do anything risky until I see some proof. Okay, some proof. And let's go and look at some cycle analysis. This is what I'll predict to you guys right here. Okay, so this is something I still have to figure out. This the mark indicators type things. Now you can see here we have a 13 cell count number 13. All right, this is a sequential cell count signal. You have a C and a 5. This is a C5 wave. So when you have a 13, you got a C and a 5. Pretty good topping. Yeah, called that top pretty well. This was like around the first week of December for the S&P 500. Now we're doing this. Well, let's say January is bad. Let's say we keep going down 4, 5, 6, 7. So this is a new count. We got 1, 2, 3 counts already for this week. These weeks. So this is each of these bars are a week. Okay, guys. So we have 4, 5, 6, 7, 8, 9. So we got that many weeks left to count to buy. So let's say we have a bad January, and then when February gets hit, we hit here 543. So if the S&P 500 is going down to 543, maybe that's the time to buy in February, March, have it go back up, and by the time it goes back up, it'll go hit here at 630. So we could have something where we go down to 540 about and go back up to 630. And then from then on, we'll see how it goes. Maybe that's where that's what we'll be doing for the first quarter of next year. Okay, guys? So I'm not saying that's what's going to happen, but looking at this thing, it's a potential. That could be a potential scenario. Now let's look at the cycle charts here. This is Bitcoin. Like I said, we were hitting the top on Bitcoin here, and this might be it. This might not recover to over 100 anymore. This might just go goof off at 98, 99, and then from then on, we're going all the way down. When's a good time to buy Bitcoin? March to April, early May. You see that? So sometime around tax time, tax season, probably the next time to buy Bitcoin again. All right? So watch out for that. Then let's look at the S&P 500 here. This is a 200-day cycle about. So usually you would see a 180-day cycle. I think that's equivalent to a 40-something week cycle. Let me, like, one of these days I got to play this. Like, there's a Dewey 41-month cycle. Okay, 41-month cycle. I'm so 180 day. I think that's about right. 41 months, right? Okay. So this is common. This cycle you'll see repeating again and again. Now, don't take that as gospel. Sometimes it doesn't work, okay? Like, look at here. That didn't work then, right? So, I mean, maybe it works, maybe it doesn't, like, all the time, but I would say you only want to get into the market when you have this push up. All right? When you have something moving down in the cycle, it doesn't mean like the stock is going to go down or whatever the index is going down. All it means is it could just go sideways. But for if you're looking for a good time to buy, you're always going to look for the point where you hit near the bottom of it, and then you look at a new cycle moving up. So that's why August, that time when we had the yen carry crisis caused by the Bank of Japan, we bought at that time because this was the greatest time to buy, and you rode it all the way up into elections, right? So anybody buying up here is being way too greedy. I'm not saying it's just going to drop, but what I will say is, like, there's a better time to buy, and that buy time is also around March. So pretty close to when you should buy Bitcoin. So not bad. So I think, like, yeah, March to April to May, probably a good time to start looking for things to be buying. But from January into March for the first quarter, I would say, sorry. If you want to buy a dip, there's a better dip coming. This ain't it. That's all I got to say. All right. So natural gas. This is the one I'm watching here. Because if you're in UNG or BOIL, so UNG or BOIL or futures, and you're all bullish here, I better be careful. You better be careful. We've had a slew of good news for natural gas. And I would be saying, like, get out. Get the hell out for natural gas. So if you're in the commodities, you should probably get out. If you're in the companies of natural gas, you're probably okay. You can just chill there. But if you're actually directly in the commodity itself using the ETF like UNG, BOIL, get out. Or you're in the futures, you're done. You already did this move from October into December, and this was surprising to me because usually by this point in December, we should already have been moving down, but we've been doing quite well with the weather reports. The weather reports the past couple weeks have been tremendous, and we've reached the peak of the natural gas weather reports because look at that. We've got a cold weather outlook for January because there's an Arctic blast. So let me see where's the Arctic blast. They talk about Arctic blast, blah, blah, blah. Oh, they didn't talk about Arctic blast? Yeah, it's basically an Arctic blast, okay? See, the National Weather Service expects a higher chance of colder than normal weather across the U.S. East and Midwest in its latest 8 to 14-day outlook. That would be an abrupt shift from what's until now been a mild fall and early winter. So all the weather models have been wrong. And now you got this good news, and you've been pushing it up Monday. So look for a short here. So if you want to short it, you can you can short it directly with the futures, or you can use KOLD. KOLD is the leverage ETF for short natural gas. So if you want to do that, I'll be looking into it. I bought a little bit on Monday, and I'll see if I'll buy more on a Friday. See what happens. All right, we'll see. But it's highly risky. I wouldn't do this if you don't want to take any risks right now before a big weekend too, because we have tomorrow's is off, right? So unless you're doing futures, you can't trade then, and then the natural gas report from Henry Hub probably doesn't come out until Friday, just before another weekend, and then, so I don't know. Yeah, it's up to you guys. So cold is short natural gas. So yeah, dude. This I don't know how well it would be. Yeah, it's gonna trend bearish, Abiola, until around April, March, late March, mid-April, and then maybe early May, maybe at least the latest. That's my guess right now. So watch out. But I think Bitcoin will try. It'll try one last chance to get to 100, like maybe in mid-January, and then we'll collapse. But it could just be like after New Year's, Bitcoin and the stock market will just all go red like crazy. I don't know. That's why it's just like be careful. Be careful. Just don't be taking big risks right now. Let's just put it that way. There's a better time to buy the dip. This ain't it. This ain't it. Let's just say that. Traders often use, they'll use Fibonacci retracements. Yes. I don't use them personally. I'll just use support resistance. CKJ3 uses the ICT the methodology is the inner circle trader. He'll use like the what do he call them? Dang, he called them gaps where it's what? Yeah, it's really specific. Like I forgot the whole. Like I haven't even researched that yet. I didn't get time. Like fair market value gap. Okay, so he uses a whole different system. You'll have to find your own way. If I use Fibonacci, it's very rare. I would definitely like 50% is important for me, but like if you're telling me like do the 30-60% and all this other stuff and then do extensions, I don't do that. Maybe Tropes might know some more since he's reading Linda Raschke's books. Like she goes over it a lot. There's another person that does Fibonacci. Oh man, she used to be called the Fibonacci Queen. Man, I forgot her name now. Oh man, she wrote a whole book just on Fibonacci. She swears just on Fibonacci. I can't tell you if that's legit, but if you really want to do Fibonacci trading, like her book was insane. Oh yeah, I found it. Yeah, I found it. Here's her name. It's called Fibonacci Trading. All right, I'll put the link in the. She's really wild about it. It's really nuts. I mean, it's sort of to me feels very schizophrenic. It's kind of like the people that believe in Gantt charts. Gantt charts, GANN, I believe that's how you spell it. And it looks like a pyramid. Like, that stuff is sort of wild. Like, I don't know. So this one, you can the Amazon link is there. It's by Carolyn Borden. Okay, Carolyn, she is the Fibonacci queen. Like I haven't seen anyone go into Fibonacci as detailed as her. Like she takes it to the next level. All right, so look her up. She does some seminars from time to time. I mean, to me, I think you should keep things simple. Okay, don't get too far off into like the weird stuff. The most weird thing I'll show you guys, or I'll try to tell you, is this stuff here. The DeMark indicators. The DeMark indicators, if you look at these 9s, and 13s, you know where that stuff comes from? It comes from the Fibonacci stuff, too. So DeMark, like in his whole mind, he has like some internal Fibonacci algorithm in his head, and then he's just doing this, that stuff. So yeah, dude, I'll tell you this. Don't go far off into the weeds, all right? You don't need to just to make some money. Like the only reason I'll do DeMark is I've seen people use this system very well to time the tops and bottoms. This is where Tropes like tries to like tell me like, how do you know when the top is? Like if a stock is like going crazy, going up, right? Like, Martin Scully's trying to short IONQ right now. Like, and he's down 50% as of a couple days ago. It's like, where's the top of this thing? Where's the top of this thing? Where's the top of this thing? And I would say, like, I think if you use this system, you probably can do a better job of finding these tops and bottoms than someone who's like using any other system. So yeah, I need to learn this a bit more. I have the book. I've read it before, but it's sort of like I felt like it's not really worth my time to be doing this. But I think a lot of you might be more interested. So I'll introduce it to you guys. And I definitely paid for this whole service here right now to do this. Like, so I might as well like get my money's worth and try to learn this, because they have classes and they're teaching me how to use this crap. And I'm like, all right, whatever. Yeah. This is national treasure, right? Yes, it's based on the golden ratio. Yes. Yeah, I'll be able to, a lot of the stuff I'm doing right now can be turned into AI very quickly. If if someone wants to help me, I'm just kind of too old, and I'm not really need to like get that. I'm not really interested in making so much money, but I think it'll be fun. It'll be a fun project for the John Galt channel. Like eventually, like we should just start like a hedge fund or do something like that. It'll be pretty cool. I think it'll be nice. Yeah, you never know. You never know. So, yes, golden ratio. What else? Yeah, I've already addressed this one with the cybersecurity. Yeah, right. So I'm definitely going to look at it if I feel conditions have changed. Okay. Yeah, there's so many wrong ways to use them. There, yeah, I don't like it. That's why I don't like it. Tropes. But read the book if you have time and you're curious. I think that book is probably the one where someone actually knows how to use it. But yeah, I think it's very rare to see someone use it correctly. You're just gonna see things that make no sense. It's like you're spending too many times looking at the clouds and trying to see patterns in it. It's just, come on. I don't like it when people get so wrapped up in technical analysis. They got to go that way. All right, that makes no sense to do it like that. All right, the other news about natural gas was European natural gas prices have reached $50 a euro, 50 euros per. I mean, $50 a euro. What the heck am I saying? 50 euros per megawatt hour. Yes. For the first time in over a year, amid cold winter temperatures, and as Ukraine is prepared to end the transit of Russian supplies. So let's look at that. European gas rises on anticipation of Ukraine transit expiring. Deal is set to lapse at the end of 2024 with no pact for new year. Kiev is under pressure from Slovakia to keep supplies flowing. So Europe, the EU, is not going to have a good time in the next year. Yeah, I think. Unless Trump can figure out a peace deal and stop all this stuff. I mean, if it's not going to happen, then watch for platinum prices to start going back up. Watch for natural gas prices to go up. There are things, and there are other reasons why natural gas should go up, though. So the weather being one of them. The other one could be China improving their economy, so coal will go up. And when coal goes up, natural gas will also follow going up, and then crude oil will go up. So all of it will go up by summer. All right, Ukraine to quadruple gas transport fees after Russia deal expires. Oh, good job. So not only is natural gas going up because of the deal not being there, well, Ukraine is going to increase the charge of going through their pipelines anyway. Great. So yeah, there's a lot of stuff going on here with natural gas. So yeah, you can look it up yourself. We have the weather. Oh yeah, and as I reminded you guys, January 9th, the stock market is closed for Jimmy Carter. I told you guys at the beginning of the stream. So yeah, remember that. Okay. Yeah, I need some Pajit coders. Man, I wish I was a software guy way back when or something like that, because it was so easy to get. Actually, Ukraine was a big place to get software people too. So a lot of people that I knew who did outsource coding because they ran like really small companies and they just need cheap code to be built. Like a good place was Ukraine. Oddly enough, Ukraine was very hot for a hot spot for getting coders. Yeah. Anyhow, that's a side note. Okay, guys, let me see. I think we got one more video, right? Or two? Oh yeah. Samantha Leduc. Yeah, Samantha Leduc. Yeah. I mentioned him about that. Oh yeah, I heard about that. I didn't look too much into it though. I have no idea what's going on. And yeah, some people were like cutting cables all over the Baltic Sea, and I don't know what's going on. Yeah, it's crazy. But yeah, I didn't pay attention though. It's just too much news now, man. There's just so much shit going on. Like I can't even know if it's real or not either. But yeah, if people really don't respect like people's cables under the sea, you're not gonna have a good time around the world. Yeah, you're not gonna have a good time. So I'm playing this Samantha LeDuc video about the shake and bake. Shake and bake.
Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
So this is a bearish harami, and the probability is that it would soften, roll over, however you want to put it. We have a little weakness. We closed at 529.60 and we're at 526.60 roughly, so $3. But the market underneath the surface is still right. The green shoots of that Friday morning for sure, with advanced decline of NASDAQ. Stopped going down on that Thursday. Friday, green shoots right at the 100-day. And you can see that intraday yesterday we had some selling, and I warned this was a bearish harami on the Qs, and that's a probability for a pullback, but not a big one. It just means we're going to have some shake and bake on a Friday. SVXY also made it all the way back up to 78.6 fib, kind of retracement right back into resistance. That's also bearish harami. Market just opened and I lost my data. That's fascinating. Crazy. But it's not too big. It's a little profit taking into the end of the week before any potential weekend risk, that kind of thing, little shake and bake. But the bigger issues, of course, what happens with a 10-year yield in a push above 4.69. So that was really on my mind yesterday. This is an important differential that I'm always showing. And I said, this is telling the truth. So remember when this was falling and the Qs were going melt up mode? And I said, And then SPY started going flat and this was falling. And I'm like, this one's telling the truth. And then we had the big 3% down day. So this is trying, but it's struggling. It's not making much of a headway up here. So I'm still not surprised we have a little shake and bake today. I'm just not surprised at all. When this is going to be funny, but when the credit spreads do start to widen and move higher, which I expect into January and such, that's actually when small caps typically come back into play. I showed that to you before when we had the July blowout. We also had small caps over growth. Yep. So it's kind of a combo deal. They go back into buying the losers, selling the winners or the VIP stocks, and they go back into kind of supporting the value, the recession, quote unquote. This is going up, and this was only down here, but it was clearly down here. So now we're getting a little bit of shake and bake. That's expected. So far today, had a few tells yesterday, but the tells were dollar and yields are strong, but this differential says, I don't believe you, that you're going to just melt up already. And then, of course, I thought this was going to catch down a little bit, which it's doing. So there were some things that were not telling the truth yesterday. It was pretty much the only way I could describe it. And now we have a little bit of a petering out in growth. And now you can see how it's rolling over. Apple, come on. 1, 2, 3, 4, 5 weeks of green. I got a 5-bar rule. It'd be very, very, very unusual for this to be 6 weeks of green. So why not? Let's see. What was the open? The open was 25466. 25466. Wouldn't that be interesting if it came all the way back down and turned this from green to red? That would not surprise me at all. Yeah, we're not falling apart. It's just a little shake and bake as far as I can see. Qs to 523. Little shake and bake on a Friday. Careful. Here's your Qs coming back in. We broke the 523.25. What did I have for? With the 21-day. Semis can't get a bid either, obviously. Nice shake and bake for a Friday, huh? This is not recovering so quickly. And VIX is above 1704. So there you go. You got to press while VIX is above 1704, which is just starting. That gives it more opportunity to move back into that 1929. So as long as it's above 1704 today, then you got your SPX, QQQ, shake and bake in progress with more emphasis on the QQQ. So it's really concentrated in the MAG 7. Look at that. All the way back down. Dollar's getting bid a little bit. SPY is printing because VIX is still launching above that 1704. That was very, very, very impressive push. Oh, goodness. Wow. That surprised me. Look at this BXM, right? That's the August 5th convexity short covering rally. And you got it all the way here into fascinating, right? A fib level. What is that? That's a doji. We open up next week. We're going to head down. In other words, above is bullish, below is bearish. We could all
Sorry guys. I think the video stopped like actually playing. Only the audio was playing like, and then it just got stuck there. Let me see what's going on. I think I gotta restart this whole thing with the video. Oh yeah, I'll be able to. Yeah, you're in a different time zone. Yeah, I could keep forgetting that. Yeah, Happy New Year's, man. All right, let me play this video again. Okay, let's see.
But the bigger issues, of course, what
All
happens
right, that makes more sense.
before
That's why I was
a
wondering why it
pullback,
got
but
stuck.
not a big one. It just means we're going to have some shake and bake on a Friday. SVXY also made it all the way back up to 78.6 fib, kind of retracement right back into resistance. That's also bearish harami. Market just opened and I lost my data. That's fascinating. Crazy. But it's not too big. It's a little profit taking into the end of the week before any potential weekend risk, that kind of thing, little shake and bake. But the bigger issues, of course, what happens with a 10-year yield in a push above 4.69. So that was really on my mind yesterday. This is an important differential that I'm always showing. And I said, this is telling the truth. So remember when this was falling and the Qs were going melt up mode? And I said, And then SPY started going flat and this was falling. I'm like, this one's telling the truth. And then we had the big 3% down day. So this is trying, but it's struggling. It's not making much of a headway up here. So I'm still not surprised we have a little shake and bake today. I'm just not surprised at all. When this is going to be funny, but when the credit spreads do start to widen and move higher, which I expect into January and such, that's actually when small caps typically come back into play. I showed that to you before when we had the July blowout. We also had small caps over growth. Yep. So it's kind of a combo deal. They go back into buying the losers, selling the winners or the VIP stocks, and they go back into kind of supporting the value, the recession, quote unquote. This is going up and this was only down here, but it was clearly down here. So now we're getting a little bit of shake and bake. That's expected. So far today, had a few tells yesterday, but the tells were dollar and yields are strong. But this differential says, I don't believe you, that you're going to just melt up already. And then, of course, I thought this was going to catch down a little bit, which it's doing. So there were some things that were not telling the truth yesterday. That was pretty much the only way I could describe it. And now we have a little bit of a petering out in growth. And now you can see how it's rolling over. Apple, come on. 1, 2, 3, 4, 5 weeks of green.
Okay, so yeah, it seems to always try to stop at certain points in this video. Yeah, I'll probably have to come back and leave and come back or something like that. Yeah, she told us. Yeah, I have the links all on the description. Yeah, so if you're interested in all the videos I'm playing right now, it's there. I probably have to restart my browser. Yeah, this is probably it does. I think I've hit the point where StreamYards has eaten up all my memory.
I thought this was going to catch down a little. Go back into the credit spreads differential that I'm always showing. And I said, this is telling the truth. So remember when this was falling and the Qs were going melt up mode? And I said, And then SPY started going flat and this was falling. I'm like, this one's telling the truth. And then we had the big 3% down day. So this is trying, but it's struggling. It's not making much of a headway up here. So I'm still not surprised we have a little shake and bake today. I'm just not surprised at all. This is going to be funny, but when the credit spreads do start to widen and move higher, which I expect into January and such, that's actually when small caps typically come back into play. I showed that to you before when we had the July blowout. We also had small caps over growth. Yep. So it's kind of a combo deal. They go back into buying the losers, selling the winners or the VIP stocks, and they go back into kind of supporting the value, the recession, quote unquote. This is going up, and this was only down here, but it was clearly down here. So now we're getting a little bit of shake and bake. That's expected. So far today, had a few tells yesterday, but the tells were dollar and yields are strong, but this differential says, I don't believe you, that you're going to just melt up already. And then of course I thought this was going to catch down a little bit, which it's doing. So there were some things that were not telling the truth yesterday. It was pretty much the only way I could describe it. And now we have a little bit of a petering out in growth. And now you can see how it's rolling over. Apple, come on. 1, 2, 3, 4, 5 weeks of green. I got a 5-bar rule. It'd be very, very, very unusual for this to be 6 weeks of green. So why not? Let's see. What was the open? The open was 25466. 25466. Wouldn't that be interesting if it came all the way back down and turned this from green to red? That would not surprise me at all. Yeah, we're not falling apart. It's just a little shake and bake as far as I can see. Qs to 523. Little shake and bake on a Friday.
Yeah, it does. It looks like for me, it might be. So if it's good for you, I guess it's good for you. But for me, it's like it keeps pausing at certain points and gets stuck there. Okay.
Here's your Qs coming back in, as I can see. Qs to this from green to red. That would not surprise me at all. Yeah, we're not falling apart. It's just a little shake and bake as far as I can see. Qs to 523. Little shake and bake on a Friday. Careful. Here's your Qs coming back in. We broke the 523.25. What did I have for? With the 21-day. Semis can't get a bid either, obviously. Nice shake and bake for a Friday, huh? This is not recovering so quickly. And VIX is above 1704. So there you go. You got to press while VIX is above 1704, which is just starting. That gives it more opportunity to move back into that 19. As long as it's above 1704 today, then you got your SPX, QQQ, shake and bake in progress with more emphasis on the QQQ. So it's really concentrated in the MAG 7. Look at that. All the way back down. Dollar's getting bid a little bit. SPY.
Yeah, if it's just me, then yeah, maybe it's just me. All right, let me see.
Opportunity to move back into that 1929. So as long as it's above 1704 today, then you got your SPX, QQQ, shake and bake in progress with more emphasis on the QQQ. So it's really concentrated in the MAG 7. Look at that. All the way back down. Dollar's getting bid a little bit. SPY is printing because VIX is still launching above that 1704. That was very, very, very impressive push. Oh, goodness. Wow. That surprised me. Look at this BXM, right? That's the August 5th convexity short covering rally. And you got it all the way here into fascinating, right? A fib level. What is that? That's a doji. We open up next week. We're going to head down. In other words, above is bullish, below is bearish. We could also stay here another week, but this is a reversal pattern. Perfect reversal pattern at a fib level. Oh boy, they're selling off concentration risk before the new year. Remember I said it wouldn't surprise me if we get to the new year with some selling in concentration risk. They're not waiting. Right here, they're aggressively already starting. Stopped yesterday, started today, right at that fib level. That's fancy. Okay, I got to take a picture of that. That's the kind of thing I look for. That's really the kind of thing I look for. So that growth rotation with follow through, it has to follow through next week. Just can't have this, right? It's got to break this and head back down. But that can be very eventful, right? That can be very, very, very productive and profitable for shorts. Apple, don't laugh at me, but I said this will go red to green. And it doesn't need much more. It opened for the week at 25466. 25466 is all it needs to go red. I know this guy. Oh, and yes, it is a reversal formation here on the daily. Look at.
I don't know if it played correctly for you guys, but I played as much as I can. I'm running out of memory, guys. I gotta leave. Okay. Yeah, I mean, I'm gonna play like if you guys want to stick around, I'll play the what's his face? Yeah, Martin Shkreli's shorting of IONQ and RIGT. So there's only 4 minutes in the market right now. I don't see any changes from what I've seen from what it was doing since midday. Okay, since noon Eastern. So it's still at the bottom. So you guys gotta wait till New Year's, man. I don't know what the shake and bake is. I don't know what's going on. We can all shake and bake all day long, but I ain't seeing nothing right now to say that we're gonna bake anytime soon. We've just shooken like since Friday, so I don't see the baking yet. So if you're gonna willing to buy, so I'm gonna come back in a bit. Okay, I gotta restart everything, and I'll come back and I'll play you guys the Martin Shkreli stuff. So hold your horses. All right, there won't be any like. I guess I could set the music, but I don't know if it'll like work while I'm away. But let's see. Let's go. The tiny violins, man. Yeah. All right, I like that. Here's the pause music for you guys. I'll come back. See ya. Oh, good. The music still plays when I leave. Oh, perfect. All right, good. Okay, let's play the Martin Shkreli trying to short quantum computing video. Let's see what things.
Quantum bubble continues. You know, the pain on the upside. Yeah, the pain on the upside tends to make you like how should I put it? Cynical or frustrated or whatever on the downside. You know, when you short these, as you have to be sort of prepared for them to go up. I mean, I don't think anybody was prepared for them to go up this much, but you have to be a little bit prepared for them to go up. And when they go up, you can't get too mad because it's kind of what you wanted. Nobody can say the second I short a stock is the time it'll start going down, because that's just obviously not the way the market works. Otherwise, you'd be, every time we pressed the button, we made profits. That'd be a very cool market. That wouldn't be called trading, it'd be called free money. So when we do trade and a stock's going up a lot and we start shorting it, you know, we're trying to tame this beast, and you shouldn't be surprised if the beast keeps going. The problem is the beast will run out of steam at some point, and you just can't, when it starts to run out of steam, you can't give up. And a lot of people just give up and say, I'm out. And that's maybe the smarter move at the moment. But eventually, when the stock's back down, you might say, I wish I didn't give up trying to fight this beast. Or you might say, I'm glad I gave up trying to fight this beast. It all depends on what happens in the end. And then it also depends on how big your position was in the meantime and all this stuff. So everyone has to learn to manage risk one way or another. Some people have to learn several times. Yeah, there's a difference between being numb and being resilient. I've shorted so many stocks over my career, it's really not. The dot-com bubble was way worse. In dot-coms, you'd have stocks that go from 10 to 100, and they were just as useless and valueless at 10. And at 100, you're just sitting there. Like, I think a couple things to learn are, 1, don't have huge positions. 2, if you can buy cheap hedges, you buy them. I think Rigetti's a great short. 3, try to be long something that'll benefit. Obviously, in this case of quantum, it's like some of the trade has been, some people have put on like, okay, let me long IonQ and short Rigetti, because that's like IonQ is a little more established and Rigetti is less established. But usually that'll work the other way around because people want to speculate on speculation. So quantum is speculative to begin with, and they're like, give me the most speculative quantum. It's like and other people, just give me the IonQ, that's a low dose. So it's it's a really fascinating bubble, but you have to understand that this is like, if you were there for GameStop, that was crazier. The dot-com bubble, that was crazier. You can't prepare for a 10x when you are short, but you have to think that it's possible. And so I'll give you guys an example. And this is kind of what I did a little bit of, which is why I still have a portfolio to even speak of. So if you short, although it's a lot smaller than it was before I met quantum computing. If you short, say, 10,000 shares of Rigetti, and let's say, I don't think Apple's a bubble. Apple's very profitable. But a bubble is when there's just an unreasonable, insane valuation, just totally out of control. So let's say you're short Rigetti, let's say you're short right now at 1747. And you want to be concerned that, okay, maybe in some crazy universe this goes to 40 or 50 or 100 or whatever. Well, you could say, let me go long, Jan 20 calls, Jan 3, wow, Jan 3rd. And let's say you could buy 100 for argument's sake, but I'm going to show you some other permutations. I'm going to put it down here. And these are the 20 calls. So let's say you buy these at $2.35. So now basically your new short break even is as if you shorted now at 15. So you have to ask yourself, by next week, will it make sense to short Rigetti at my 15.12 break even? Am I willing to short Rigetti at 15.12? And you might say, yeah, I mean, it's up $2 today for no reason. Even if that reverses, I'm now good to go. But it may not reverse, it could get worse. So why would I lower my break even? That's annoying. I don't want to lower my break even. I want my break even to be as high as possible. Well, the nice thing about this break even is that it protects you from any move above 20. So you've capped your max loss to 22.35. So the most you can lose here, at least in 1 week, is if the stock goes to say 100, well, you lose $83 on the common stock, and that's times 10,000. So you lose $830,000 in the common. Well, that would mostly put you in bankruptcy, but the calls go up. The 20 calls at 100 are worth 80, and you bought them for $2.35. So you made $78, and that's also times 10K. So you only lost 50K. So the most you can lose in this scenario is $50,000. So you can plan out ahead of time, how much risk do you want? You can know exactly what your max loss is. And you can do this in a partial amount. So you might say, well, I want to be short some. I don't want to lower my break even that bad. So I'm just going to buy 50 calls. Well, that's great. Your break even is a lot smaller. So you would profit even at say 16. But on the flip side, this gain would be much less, be something like 39 or something, and you would get smoked on the upside. Now you could do something even crazier, and you could do 150, which is like an overhedge. And this lowers your break even further to say a 14 or something. But in the event that the stock goes really hog wild, you actually would make money. You have this weird P&L that looks like this. You kind of lose money down here. You lose money if it stays anywhere near its current price, but you make a fortune if it goes down a lot, and you make a fortune if it goes up a lot. So there's a couple of ways to play this. You just take unmitigated downside risk. You're basically saying, I want to go naked short, not naked short in the SEC sense, but just short without a hedge. That's fine. But you just have to be prepared that you might be wrong. And look at Cassava. Cassava went from, if you guys recall, I think 3 to 100. Then it went down to the 20s when we started shorting it, and it went up to 30 before it went to 2. And in biotech, you have that exact day and time when you will, know what the results will be. Even then, they might try to squeeze you out of the stock. So this business is very tricky, and I feel bad for anybody that if you just started watching me and you saw the Galt gain, you saw the Cassava gain, you said, oh, this is easy, this guy's great, I'm going to short these quantum stocks like he's doing. Well, a couple things. I mean, my portfolio for the public is a YOLO portfolio. I turned it from 100K to 1.1 million, and now I'm down about half from the 1.1 million.
All right, you got a little bit of that. Okay, 100K to 1 million, back down to 500,000. Anyway. Yeah. So, trading ain't easy. You can win big, you can lose big. I try to always tell people, you just want to get base hits. You want to just do free throws, layups. Don't be doing Hail Marys. Don't be doing crazy shit. Like, it's just, you can make pretty good money just trying to build it up gradually. Okay, you don't need to be doing crazy YOLO. Yeah, YOLO portfolio. So there you go. And we're entering into a new year. Let's watch what these stocks will do. I'm not going to play the rest of that video. You can go, and it's in the link in the description. You can go to Skrelly and watch the rest of it. But I think you got the idea, right, with him. So he's very aggressive. He loves shorting, too. He loves doing that, especially pharmaceutical stocks. He thinks there's fundamental problems in. If he thinks like this company is making a drug that can never go anywhere, he'll just aggressively short some of it, right? AI, you don't really need to, Abiola. Like, most people can make pretty decent money. The only reason you really want to get the AI going or something, if you are just somebody who's interested in playing with big money or manage other people's money and try to do a lot of that work for you, because it's very time consuming to be analyzing a lot of charts. I talked a bit about scanning. We can do scanners, but that's still inefficient. Okay, short term is stressful. Yeah, you don't need to do short term though. The same stuff I teach is applied long term. All you do is you change the time scales. Instead of looking at 3 minute, 1 minute, 2 minute, 1 hour, 1 day, then you shift it to like 1 day, 1 week, 1 month, and then you can go even longer. We could do 1 week, 1 month, 1 quarter, 1 year, right? So everything can be, it's all fractal. Everything can be done at anybody's time frame. And that's hopefully I introduce concepts that you can use in any case, right? And short term makes more sense if somebody wants to be more aggressive or they see opportunities. You can see a lot more opportunities in certain areas than others, right? You could be at a point in the market where like it doesn't make too much sense to be short term, right? It's better to be a swing trader, so swing around every month. Maybe it's like something where you can do it every quarter, right? And then we could be entering a market where we go sideways. It doesn't make any sense to actually be investing on a quarter basis. We could just be like month by month or week to week. It could be that. That's where AI could be much more useful. It could identify that and say like, oh, look at all these stocks setting up this way, or these sectors setting up that way. Yeah. Man, I think that'll be great. You know, you don't need a team of people like to do this stuff. You just get AI to help you out, and do a lot of the bitch work, I guess. Joe Rabel, you know, yeah, that's the thing about tropes, you know, with Joe Rabel. Joe Rabel loves doing everything by himself. He loves looking at charts. You know, he just loves. So a lot of his analysis, if you buy his packages, I guess, what he'll give you is his own personal analysis. He will just every week he'll go through every stock in the S&P 500 and eyeball it by hand. Like, he just likes looking at charts so much that it's not a chore to him. For me, I'm like, dude, this is boring. I'm not gonna waste my time looking at thousands of charts all day, right? Every weekend, like let's say every Sunday before the week of trading commences, I'm just gonna look at thousands of charts and identify, eyeball, and try to figure it out. Or that's him. Some people, they'll use a scanning and they'll try to like narrow it down using a scanner system, which I'll do more of next month and show you guys more examples. Or, you know, as Abiola says, like, hey, why don't we just get AI to do more of this stuff for us? So that will eliminate more of that work and get rid of that, and you know, it'll help us out. And then we can spend more of our time like focusing on trying to improve like the system, instead of working like at the bottom levels and trying to just, okay, we establish a system, but now like we have to do all the grunt work all the time and do it. So yeah, that's something to consider. Definitely something to consider as we get to the new year. So this was only 3 months I've been doing this show, right? Since October. I did the introduction. I gave you some stock tickers in November and stuff, you know, and then December we're transitioning now, trying to say like, okay, let's put everything together, all the work together, and start making new shows where I just have like different ones, and just do a show just on like doing a portfolio that just does long term, do some swing trading, do some day trading, and yeah, you know, we could have it all at once, going in parallel, right? And then we could have tutorial shows and things every 2 weeks or so, or maybe even like twice a week if I have enough time. Yeah. So yeah, I think a lot. Yeah, Garion will help me a bit, probably doing the clipping and stuff, and yeah, we could do more. Yeah, with AI, definitely could do a lot more. And I know, you know, Portia knows, probably can help out here, and we'll see. Yeah, we'll see, man. Yeah, I didn't expect to do too much, honestly, with this stuff. But since a lot of people are probably going to get more and more interested as we go on in the channel, yeah, we're going to give more to offer to different types of people. And yeah, so it's New Year. Happy New Year, y'all. This is end of 2024. Now we're getting 2025. It's going to be hard. It's going to be hard to have easy money as we did in the past 2 years. And we're going into 2025 to 2026. I expect a lot harder. So I'm going to have to figure out all that DeMark stuff for you guys. See if that will help them out with the timing a bit more. Maybe give more insights. And then we'll slowly try to do more of the tutorial stuff again. Look at the Wyckoff analysis, right? And yeah, well, I'll have to introduce the homeworks. And then maybe, yeah, since Tropes is reading the book with Joe Rabel, I'll definitely start playing more of his videos, like old videos, and say like, hey, what do you see? What do you do? And then we're going to keep practicing. Then we're going to start doing practicing, more tutorial types work. Man, I don't know. I'm probably biting more than I can chew trying to do this into the New Year's, but let's see. All right, guys. Happy New Year's. Don't drink too much. I'm not going to be drinking too much, I hope. But yeah, maybe I will. That's yeah, depending on what's going on the other 24-hour stream. All right. See you guys. See you Abiola. See you Trope. See you All Seeing Guy. See you Eric W. Who else showed up here? Like a lot of people showed up. Let me see. See you Humble President. See you Garion. There was one other person. Oh, see you Bandit. He only commented once. All right. Thank you. See ya. Yeah. That'll be fun. Yeah. I think Tropes. Just focus on the trading. I definitely will need someone to help out. I don't know if we can do AI sometime down the road next year, but yeah, that'll be so helpful. Damn, God damn it, I'm just so lazy, man. I'm not like Portia. I just can't be doing like this stuff. I'm retired. I swear to God, I'm just like, I'm done. I don't need to make big bucks, man. But I'll definitely make big bucks if you guys want me to help you guys, other guys make big bucks, and we could do a hedge fund because, yeah, right. John was thinking about doing that, where we just have a GoFundMe or what's it, GoFundMe? Or, I don't know what he wanted to do, something like Master Kim was saying. And we just take people's money and start using that to build a portfolio and trade or whatever and build up. Yeah, it's possible, man. So let's see. Let's see if we can do it. All right. Have a good one.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should. Feel like I should go.